everyone. So in today's class, we are going to do the final marathon, and before starting this, I am hoping that I am audible to all of you. My screen is visible and I everything is fine. Okay, and in this final marathon, we will try to cover all syllabus in just two classes. We will cover all the important things and all the bullet points, important topics, and whatever is required to clear our exam. Okay, so just give me some seconds, then I will start. Okay, so today module A and module D we will cover. Then tomorrow we will cover module B and module C. That is the combination of covering the things. So yes, let's start. Foreign exchange definition and markets. We know that in today's global economy, countries need to exchange the currencies. Why? Obviously to trade the goods, to trade the services, and even the capital. For example, if an Indian company export goods to the US, they get paid in the US dollars. And definition is saying that the Foreign Exchange Management Act defines foreign exchange as any currency, any foreign currency, as well as things like foreign bank deposits, drafts, traveler's check, letter of credit, bills of exchange that are payable in the foreign currencies. That comes under the foreign exchange. It plays a very crucial role in the international trade, travel, investment, and tourism. In very simple words, foreign exchange includes all the money or the claims that can be paid in another country currency, whether it is cash held in foreign banks or the documents like checks that can be paid in a foreign currency. Okay, and all of these activities rely to the ability to exchange the currencies. In short, foreign exchange is vital, is important for the country's growth and global interaction. Okay, and also you can tell me the doubts, whatever you are feeling, or anything which is not understandable to you. You can just do the comment, just like please repeat the concept, or I don't understand this. You can freely comment. Okay, and my voice is audible as well as yes. Okay, so just do the comment, what wherever you feel any type of doubt, just write it. And yes, also if you feel, if you need break, just you can also tell me. Okay, now exchange rates and the forex business. Exchange rates and the forex business. Just a second. See, whenever we talk about the foreign exchange transactions, we mean what? The exchange of money. The exchange of money from one currency to another at an agreed upon rate. This process of converting one currency into another currency is called foreign exchange. And for the India, US dollars, euros are considered as foreign exchange when used in trade. But when in Germany or the US, the Indian rupee is foreign exchange. Understood what is the meaning of foreign exchange? Okay. What is the foreign exchange market? Forex market, FX market, in short we say. This is a global network where currencies are bought and sold. It includes a wide range of participants such as individuals, businesses, commercial banks, investment banks, central banks, hedge funds, speculators. all are the wide range of participants. And with the help of these participants are the main participants who buys and the sells currencies on their needs, such as for the trading, for the investment, for the speculation. Forex market is not a physical marketplace but a communication system that connects countries and participants around the world. And it is a market where participants can make a profit but also faces some type of risk of losses. And one more thing here, this is not a physical market, this is 24 into 7 market, can be operated from anywhere. Okay, it operates 24 into 7 because there is different time zones in all over the world, and this means when market in one part of the world close, other are still open. That does not mean in India if the market is closed, in another country it is also closed. No, when markets in India are closing, the markets in New York are just opening, and markets in Asia are waking up before New York closes. So this is the connections between the timing of different countries. Clear? And also, sorry for the voice, due to having the cold, the voice may be different, but I try to give here. You can see I already told you the participants of the foreign exchange market, and here who participates in the foreign exchange market: central banks, commercial banks, investment banks, funds, forex brokers, and also here corporations, individuals. They can participate in the forex market, they can do the trading, they can buy the currency, they can sell the currency, they can do everything in the forex market. Okay, and this thing is clear now. Forex market is very fast, and constantly it is changes. Currency exchange rates for the major currencies can fluctuate in every 3 to 4 seconds. So you can see around 21,600 changes in a day. So if you look away from the market for even a moment, the exchange rate could have moved up or down. And there is a question on our book, Macmillan book. If we see, there is a fill in the blanks that in how many seconds the market is fluctuate. So in every 3 to 4 seconds is the correct answer. Okay, so in short words, what we can say, the forex market is essential for the global trade and for the finance, with many different players exchanging their currencies to support their business, travel, and the investment needs. Okay, done with this concept? Understood what is forex market? And in India we are saying that forex market also sees the significant growth. The average daily turnover in the OTC market, over the counter market, increased from near about 5 US dollar 5 million 5 billion, sorry, to US dollar 34 billion. Okay, so you can see the growth of forex market in the India. And also now with the help of smartphones, with the apps, it is easy to access the forex market anytime from anywhere. Okay, clear that concept of forex market, that is important in this. It operates daily, globally, from Monday to Friday. Saturday, Sunday is week off, but if there is any important transactions that can be happened on the Saturdays, Sundays as well. And in Dubai, Dubai is basically used to closed on Fridays, but now following the same concept, the Monday to Friday schedule as the rest of the world is following. Okay. Yes, in this, I already told you this, the forex market is a OTC market, over the counter market, which means trade happens through phone calls, emails, electronic platforms, trading system used by the banks, brokers, news agencies. These are the major platforms where the forex market doing the transactions. And if we talk about the London, New York, Paris, Mumbai, Tokyo, Singapore, they are trading the currencies with each other across different time zones. They can adjust the communication accordingly, and some traders even they are working from the home. Okay. Then main characteristic of the forex market, it operates 24 hours a day. It is an over-the-counter market, means trading happens through electronic systems or the phone calls. It is a global market with no specific location or no barriers to entry is there. Anybody can join, anybody can do the transactions. It handles a large amount of money and also supports the major trade flows. It is a highly liquid market, meaning it is easy to buy and sell the currencies, and also currency rates fluctuate a lot, sometimes every few seconds. The time zone factor affects how settlements are made. Market is basically influenced by the government policies and the regulations. Okay, so this is the characteristics of the forex market, main features. Now some are the factors which affecting the exchange rates. First one is fundamental factors, fundamental regions. This includes all the events which affect the basic economic and the monetary policies of the concerned government. The causes normally affect the long-term exchange rates, while in the short run, many of these have less effect. And in the long run, exchange rates of all the currencies are linked to fundamental, and it include balance of payment, economic growth, fiscal policy, monetary policy, interest rate, and some political issues also. These are included in the fundamental factors. Clear? Now, if we talk about the technical factors, they are shorter, driving the regions for currency movements, influenced by the government policies, capital flows, and the market speculation. Okay. Technical factors basically includes the government controls, sometimes government restrictions on the value currencies, on the capital movement can cause the currency to become overvalued or undervalued, which leads to the sharp fluctuations. Clear? And basically this government controls can also lead to some type of unrealistic value of a currency, which results in a violent movements in the exchange rates. Okay. Then you will see about the speculation. Speculation is the third factor. These are the basic, we can say, speculative forces can have a major effect on the exchange rates. Speculative deals provide the deep and liquidity to the market, and at times act as a protection to cushion, we can say, if the views do not lead to the some type of bad effect. So basically speculators, traders betting on the currency movement can cause the big changes in the exchange rates. If trader expects a currency to lose value, they might start buying and selling currencies based on that prediction. And this behavior can lead to the large shifts in the exchange rates. And it due to this speculation, speculators basically makes the market more liquid and active, but it can also cause some unpredictable swings if many people act on similar expectations. Okay, basically speculation, we do the predictions that the rate will be changed, and the rate, you can see the examples on the CNBC Awaz, there is Indian channel which shows the value of all the currencies at uh, same time, and the whole day they tell that this share will reach at this price. So these are the example of speculation. Okay, so many different channels are there, but CNBC Awaaz, I think, the famous channel. Okay, spot deal. Spot deal means when the settlement is uh, done after the 2 working days. When the currency exchange happens 2 working days after the agreement is made. This basically comes under the exchange rate mechanism where the types and calculations, and in this first type is a spot deal. If for example is also given, if there is a bank A which buy in India who buys the US dollar from the bank B, that bank is in Germany on the 1st of November. So the exchange will happen on the 3rd of November, 2 working days later. This is called the spot deal. Settlement of funds basically takes place after 2 working days. And if in case after 2 working days there is a holiday or any public holiday or sudden holiday, that they will be shifted to the next working day. Clear? Now, term deal, when the settlement of funds takes place on the next working day from the date of deal. The term, that is tomorrow. Tomorrow means the currency exchange happens the next working day after the deal. That is term tomorrow. Ready or cash deal. Ready or cash deal basically when the settlement of funds takes place on the same day, immediate effect we can say in this case. Okay, so the cash deal, ready or cash deal happens on the same day as the transaction is made. I hope this is clear to all. Forward deal. What is the meaning of forward deal? Basically, forward deal we can say here uh, when the delivery of funds takes place on any day but after the spot date. When the delivery of funds takes place on any day after the spot date. Forward deal is when the currency exchange happens later than 2 business days at a future date. That is called forward deal. You can see the example. If a bank A in India buys the US dollar, this amount from the bank B on the 1st of November at a rate of this, but the settlement will happen on the 30th of November. That is called forward deal. Clear? Spot rate is used for the deals that settle in 2 business days, but forward rate is used when the deal settles beyond the spot date, like in forward deal after the 2 business days. This is spot rates and forward rates. And basically, spot rates are for the delivery of currency or exchange of the streams of currencies that dealt in on the second working day from the date of deal or transaction. When the delivery of the currencies is to take place at the date beyond the spot rate, beyond the 2 working days, that is called a forward transaction, and the rate is applied is called forward rate. Clear? Now let's talk about what is forward contract. Okay, so forward contract here, as you can read, what is forward contract? Forward contract means basically a type of a agreement in which buying and the selling of currency at a specific price on a future date. And these forward rates are derived from the spot rates and are a function of the spot rates, forward and the forward premium discount of the currency being here quoted. So you can say what is the formula for a forward rate? That is equals to spot rate plus premium minus discount. Clear? Spot rate plus premium minus discount. If the forward value of the home currency is more than being quoted for spot, then it is said to be the premium, and the currency is cheaper on forward date than spot. This case is called discount. Clear? Okay. Forward premium, forward discount occurs when the value of the currency is higher in the future than it at the spot rate, and the forward discount occurs when the value of a currency is lower in the future compared to the spot rate. Okay, direct quote. Direct quote, we can say under direct quote, the local currency is variable. Says if in India, $1 is equals to some amount 74.9500, and the selling amount is 74.9600. So in this, the rates are called direct. Home currency or the price quotations as per the rupee cost of the foreign currency is known directly. Means this amount in this $1, if for the buying, this is the amount for the buying and this is the amount for the selling. Indian rupee is the home currency, and the code tells you how many rupees are needed to buy $1. This type of quotation is called home currency or price quotation, because the local currency is one here being calculated. And in this case, also indirect quote. Indirect quote is when the foreign currency is fixed and the number of units of the local currency varies. Okay. If for rupees 100 US dollar that amount is given, that means for the 100 INR you get the 1.3342 US dollar for the buying and 1.3340 US dollar for the selling. Here INR is fixed, that means the foreign currency or US dollar is being calculated. Means under the this indirect quote, the local currency remains the fixed while the number of units foreign currencies varies. Clear? And one more thing in this, there is a concept of cross rates. Cross rates, what we can say, like where in a market rates for the particular currency are not directly available. The price of the said currency pair is obtained indirectly with the cross rates mechanism. As I told you, I already explained you the numerical on the cross rate basis, where you have to find the value of the currency. Clear? Now, direct quote, indirect quote, that is the thing. Now, most important, fixed versus floating exchange rates. Okay, that fixed exchange rate is the official rate which is set by the demand factors for that particular foreign currency. Okay, or also by the government, central banks, which is linked to the another major currency like the US dollar or the euro. And while floating exchange rate is decided by the inflation differential between the home currency and the foreign currency. See, fixed exchange rates are set by the government or central bank, but floating exchange rate is decided by the inflation differential between the home currency and the foreign currency. So, fixed exchange rate, this is when a country currency value is set by the government or central banks and often linked to another major currency like the US dollar or the euro. For example, a country might decide that its currency will always be worth a fixed amount of US dollar. And in the case of floating exchange rate, in this system, the value of currency is determined by the supply and demand in the market. And India is switched to the floating exchange rate, which is linking the external value of our rupee from a basket of the currencies, where currency fluctuations are dependent upon the fluctuation on a basket of currencies. It can rise or fall based on the factors like the inflation rate in the country, economic performance, and how much of that currency is being bought or sold. Sometimes, even in a floating exchange rate system, the government allows the currency to fluctuate only with a certain range. This range is set by the central government to prevent too much volatility. Clear? Now, bid and offer rate. Simple, in very simple words, we can say the buying rates and the selling rates are also referred as bid rate and the offer rate. Bid rate in the forex market, this is the price at which a bank or financial institution is willing to buy a currency, and in offer rate, this is the price at which the bank is willing to sell a currency. Buying and the selling price is called bid rate and offer rate, and also offer rate is called ask rate. Okay. So if the quote is given like this, so this is the buying rate and this is the selling rate. Clear? Okay. Value date is that when the payment is actually processed or when funds are credited to an account and interest starts occurring, that is value date. When actually this payment is done, processed, funds are credited, everything is done, that is called the value date. This is a question also in the Macmillan book. Telegraphic transfer. In a TT transfer, when the value date is typically the same for sending the or receiving the parties, meaning the payment happens on the same day. Okay. So if there is a delay between receiving and sending funds, interest compensation is paid to the party that has to wait for the funds. This interest is usually adjusted by changing the value date if both the parties are agreed. This is the concept of value date and the telegraphic transfer. Clear? Foreign exchange dealing room operations. Forex dealing room operations comprise of the functions of a service branch for meeting the requirements of the customers of basically other branches, divisions to buy or sell the foreign currencies. Which are basically manages the foreign currencies, assets and the liabilities fund, and also manages the Nostro accounts, and are also undertake some type of proprietary trading in the foreign currencies. And just see the screen properly so you can read. Foreign exchange dealing room is a place where banks handle all the foreign currency transactions. Clear? Here, it includes buying and selling, managing, handling the accounts. It operates as a profit center, meaning its goal is to make money for the bank. Obviously, every organization is working for only the profit. And this dealing room is essentially supporting other parts of the bank, and the operations of the dealing room are following the strict rules that ensures that everything is done correctly. FEDAI regulations, FEDAI, Foreign Exchange Dealer Association of India, internal guidelines or the internal bank policies, internal control guidelines which are set by the Reserve Bank of India. Okay, so these dealing room operations are follow these strict rules that everything smooth perfectly, everything is running perfectly. What are the key roles in the dealing room? The people who are working in the dealing room as the dealers, they are very important for the bank success because they are working for the profit for the bank. They are very good quick thinkers, very good in decision making. They know how to deal with the pressure. They are making the fast decisions. But if they do a little mistake, that means that day the profit is nothing, that wipe out all the profit. And what are the advantages, what are the qualities of the best dealers? They can handle the stress well, they are responsible for the quick decision, they are okay if they do the mistake, they are willing to admit the mistake, they can work aggressively but carefully in the high stakes environment. They trust each other and they do work in cooperative way, they communicate very openly. Yeah. And also there are three types of treasury activities. Banks integrated treasury activities are segregated in the three parts. First one is front office, that is the dealing room, mid office, which basically the risk management department, and the back office, the settlements, accounting and the reconciliation department is called back office. Basic question can be come from this. Okay. Are you just tell me that everything is okay? Are you able to understand what I am trying to saying here? Like you are means you are giving your time, you are watching this that everything is okay, you are understanding the things. Just you can do the comment. Okay. Also, why this integrated treasury is important? Because here the interest rate deregulations, because more freedom in setting the interest rate, liberalization of the exchange controls, relaxed rules on exchanging the currencies, development of the forex market, also the advancements in the settlement system, it improves the system for setting the transactions, changing the market conditions, like they know how to deal with the complex environment, because there is always market risk is presented for the banks. When market risk is what? When the fluctuations are there in the market and they affect the bank, that is called market risk. What are the functions of the integrated treasury? First one, they have to meet their CRR and the SLR requirements. Why? For optimum mix of the investment portfolio, they have to analyze the major cash flows, funding mix and yields expected in credit and investment. They have to see the growth rate of the balance sheet, pricing of the assets and the liabilities in accordance with the prescribed guidelines. Risk management, proper risk management with the proper strategies, proper mitigation strategies, transfer pricing, development of IRS, arbitrage, capital adequacy, minimizing the level of provision requirements, and liquidity and funds management. This function involves analyzing the cash flows, that how much money is coming, how much money is outgoing, to ensure that banks have enough liquidity to deal with the, thank you Shalaka sir, to deal with the liquidity risk. Liquidity risk is when the obligations are there to, liquidity risk is basically when the bank have not the enough money to complete their obligations. Asset liability management basically focuses on the bank's assets and the liabilities, like deposits and the borrowings, and assets and loans and the investments. Risk management, it is responsible for the market risk, where the effect will come on the banks due to the market fluctuations. Credit risk, when the borrower is fail to repay the principal or interest, that is credit risk. Operational risk is due to the internal errors of the organization or the bank. Derivative products, the treasury develops these derivative products like interest rate swaps. Why? because to help the banks so they can manage its exposure to interest rate changes. It also sells these products to the customers, which basically are very helpful to manage the financial risk, capital adequacy. This treasury focuses on the capital adequacy, that every bank ensure that the bank has enough high quality assets, and it aims is generating a very good investment returns on the investment. Some are the internal guidelines on the foreign exchange dealing rooms. First one, like the data processing systems used must be appropriated to the nature and the volume of the activities in order to ensure the functional separation. Then accessing the rules for performing different functions that should be defined in detail and drawn up for person that are unconnected with the dealing activities. Confidentiality of data in that systems that may be ensured in case of outsourcing of the IT services to the external agencies. So if the bank outsources at IT services, it must ensure that the data is protected and not misused. Clear? Then model validation, we can say here the risk model must be reviewed regularly, that they are still effective and the up to date. Dealer limits, each dealer should be aware for the limits that is assigned to them and must work within these limits to avoid excessive risk. And here we can say what is the meaning of stop loss limits. Stop loss limits, we can say, is a type of stop loss orders that involve two price points: the price at which the order is triggered and the price at or below when the order is to be executed. And deal limits, all the foreign exchange deals must comply with the various types of limits: stop loss limits, country wise exposure limits, NOPL, individual gap limits. These are the things which are included in this. Also we can say in this periodic review and the validation of the existing models. I told you every dealer should be advised of the limits. All the deals done have to be within the corresponding limits which fixed and approved by the bank's board. Evaluation of the foreign exchange profit and losses and the closing rates of every month as announced by the FEDAI. Okay, then the three main parts. First one is front office, that is also called dealing room. And in this dealing room, where the actual buying and the selling of currencies happens, dealers makes the decisions very quickly based on the market conditions because they are perfected in it, and any mistake can lead to the significant type of loss, a very big loss maybe for the banks. Now mid office, that is also for the risk management. Here this department monitors the risk and ensures that the bank positions are safe. Mid office helps in managing the risk by monitoring the dealers activities. It also ensures the dealers are following the bank's guidelines and helps them providing the market information. Mid office also makes sure that the treasury operations comply with all the rules and the regulations. That is front office, dealing room, where actual buying and selling happens. Mid office, they are helping in how to manage the risk. And third one is back office, settlement and accounting. In this back office, this team handles all the paperwork accounting, and reconciliation of the transaction. This back office is responsible for processing the deals, handling the accounts, ensuring that everything is reconciled correctly. If the bank office does not work properly, it could lead to the error that might affect the bank's financial result and even allow dealers to manipulate the transactions without notice. Clear? And you can see the difference between these office: funds management, Nostro accounts, market risk is there in the mid office to control how to market risk, confirmation of deal is done by the back office, foreign exchange advisory management, liquidity risk, settlement of deals, and ALM and maturity mismatches in this country risk, accounting of deals in done in the back offices. They are dealing in the interbank market. They are having the ALCO committee, and in this reconciliation is done. Trading in the interbank market is in the front office. Reporting to the top management is in the mid office. Audit facilitation and the reporting is in the back office. Compliance, and compliance. This is common in both, in front office, mid office, and back office. Okay, so RBI is giving the instructions that bank have to create the policies and they have to set the limits for their forex dealing operations. These the management of these operations basically focuses on how to manage the risk, how to deal with the risk, if any complex situation is there, how to deal with it, and some of the major risks which are associated with the foreign exchange dealing that management needs to be aware. First one is some of the risk I can tell you, like operational risk, exchange risk, credit risk, settlement risk, liquidity risk, market risk. Operational risk due to the internal failure uh, of the basically bank software, and due to the humans, due to some external events like the COVID-19 pandemic. This type of situations comes under the operational risk. Exchange risk, it is arise basically mainly on the account of the fluctuations in the exchange rates. Credit risk, it is a risk of loss which arises due to the inability or unwillingness of the counterparty to meet the obligations at maturity of the underlying transactions. Settlement risk is, it is the risk of the failure of the counterparty during the course of settlement. Clear? And liquidity risk, we know that there's a potential where the uh, liabilities are drained for a bank at a faster rate. And market risk, when there is adverse movement in the market. Now, how to manage the risk in the forex dealing? What are the things for managing the risk in the forex dealing? Okay, so every dealer should be advised of the limits that are allocated to him or her, and the work within the limits. A comprehensive risk management plan should assess and manage these risks to ensure that banks can operate within their risk limits. The foreign exchange dealing room is an important profit center for the banks, so managing these risks is very crucial for the profitability. All deals, all deals which are done with the counterparties are to be within the corresponding limits. Banks basically, these forex dealing rooms balances the risk and reward, and bank need to appropriate level of risk appetite. Now what is risk appetite? This is a very common term in which basically willingness of the bank is checked, like how much risk a bank can take. That basically the willingness of the bank, that how much risk they can take, because risk and profit are connected. If we see the concept of business studies here, risk and the profit, uh, the concept of profit and risk, they both are connected, because if we are taking the high risk, we have the more profit. But if we taking the low risk as an organization, that means low profit will be there. So we can say here, this is managing, forex dealing is manages the risk and as well works for the profitability for the bank. And a dealing room typically includes the dealer who trade the currencies and who processes and settle the transactions. Effective controls are also essential to prevent any type of fraud, any type of error, any type of manipulation of the currency rates and the positions. And this also includes separating the roles within the dealing room to ensure proper checks and the balances. Clear? And overall, we can say overall positions that to be arrived, here at the end of the day and well within the done with the bank's approval. Then also one more thing, derivative products. Okay, a derivative is a financial product whose value is derived from the value of another underlying asset or exposure and includes the future, forward contract, option contract, swaps, etc. And in this basically though two different objectives. First one is speculation. Speculation means use of derivative instruments to reduce the risk associated with the everyday management of the corporate cash flows, and also the hedging. Use of these to reduce the risk associated with the everyday management of corporating cash flows. Clear? Clear everything? With the rise of MNCs, the growth of international trade, the use of financial derivatives have become very important. Derivatives are the financial product that derive their value from the something else like commodities, stocks, bonds or foreign currencies. And the main types of derivatives are future, forward, option, swaps. Okay, so now foreign currency futures. What is this? Foreign currency futures. Basically, it is also a type of agreement which is traded on an exchange that lets you buy or sell a specific amount of foreign currency at a set price on a future date. It works similarly to future contract for other products like cattle, metal or gold. That is foreign currency future contract. Clear? Okay. Moving now to the next slide. Settlement methods can for futures contract can be settled in the two-way. Basically, physical delivery where the actual foreign currency is delivered to the agreed upon date, and the net settlement where instead of delivering the actual currency, the contract is closed by making a payment to settle the difference between the contract price and the market price. Now some are the characteristics of the future contract. It is a standardized contract and it is dealt on the exchange only, and then prices are determined based on the open or mostly presently on the electric trading platform based on demand and supply. And settlement prices underlying assets are to be declared by the sellers with regard to asset quality. Details of traded units, like we can say here, the terms and the conditions are standardized. The quantity, maturity, lot size, price limits, and also like quality or grading and in respect of commodities, so on and these things, these contracts should stipulate the detail of each and every element of the unit that is traded. And settlement price is generated even through an face to face on the floor of the exchange or electronic trading platform. And the clearing house conducts the trade and guarantees the buyer and the seller the commitment on behalf of the related parties. And managing these credit risk by the clearing house is through the maintenance of the margins. That is the characteristics of future contract. Okay, clear? Forward contract, it is a private agreement which is based between two parties where they set the exchange rate for a foreign currency in advance. Just you can see the things now clearly. This forward contract are basically, we can say, a private agreement which is made between the two parties to set the exchange rate for a foreign currency in advance. And also these contracts are customized for every situation, not traded on the exchanges. They are the over the counter product, meaning they are arranged directly between the buyer and the seller. Clear? Okay, what are the characteristics of forward contract? First one, there is an agreement between the bank and the customer. Like agreement between the bank and the customer agreeing on a price for a particular amount specified for the delivery at a future date. Then delivery terms basically, we can say delivery either under options basis or on a fixed date, that is delivery. Generally duration for the period up to the 1 year and can extend beyond 1 year. It is depending on the majority of the underlying assets. Documentation verification is there, every evidence, every genuineness of the underlying, verification of the underlying and making the original document. And then hedge duration, contract should be alignment with the credit limits. Also maturity of the hedge should not exceed the maturity of the underlying utilizations. And the cancellations, basically contracts are to be utilized either prior to maturity or on a maturity date. Clear? And if not utilized the maturity and it is cancelled, profit and losses are settled as the case may be. Okay. Okay, so now let's see the difference between future and forward contracts. What is the difference between future contract and the forward contract? Size forward are of any size while futures are standardized. This is written here. Then maturity period, forward are generally for maturities up to 1 year and beyond, while futures are generally up to 1 year. Okay. Parties involved, forwards are between clients and the banks, but futures are between clients and the exchange. Price in a forward contract is determined by the bid and ask quotes, selling quote, while prices in the future determined by the spoken bids on the exchange floor or the electronic trading platform. Collateral in forward contract, there is no explicit collateral, while initial margins and on mark to market basis additional margins are needed in a future contract. Okay, so forward contract do not require any type of collateral, but while future contract require initial margin. Then settlement, forward contracts are settled on the agreed date and or cancelled. Future contract can be settled either by offsetting or through the physical delivery. market hours. Forward markets are open for 24 hours as per the convenience of the parties, while future market function during traditional exchange hours. Okay. While in the forward contracts, parties are in the direct contact. The parties in the future contract are not known to each other but deal through the exchange. And there is no explicit commission earned under the forward contract, and bank earns through the bid and ask spread, while under future a single commission concept is always prevalent. So in short, forward contracts are customizable agreement between a bank and a customer, while future contracts are standardized agreements which are traded on the exchanges. Clear, everyone? Then moving forward, just give me a second. Okay. Options. What is the meaning of options? Basically this is type of a contract which gives the purchaser the right but not the obligation to buy or sell a given amount of the security, stock, currency at a fixed price per unit for a specified time period. And there are basically two types of main options. You can see, read this, what I told you written in this. Call options. In this, the buyer has the right to purchase the currency, generally imports. But in put option, buyer has the right to sell the currency, generally exports. The person who buys the option is called the holder, and the person who sells the option is called the writer or grantor. Okay. Now, pricing of an option combines five things: present spot rate, the current price of an asset in the market. I wrote the meaning of also this with this okay. Time to maturity, forward rate of for the underlying matching maturity, interest rate for the intervening currency stock security, and also the volatility, a standard deviation from spot to forward rate. So this is the combination for the pricing of any option. Clear? And also one more thing, every option has three different type of price elements. First one is this strike or exercise price, which is the exchange rate at which the option can be purchased or sold. Then the premium, which is the cost of the option paid at the time the option is purchased, and also the actual spot rate. Actual spot rate in the market at the time option contract is purchased. Clear, everyone? Now, okay, add the money, in the money and out of money options. Add the money. Okay. Add the money, an option that is considered at the money when the price at which you exercise the option is the same as the current market price of the underlying asset. So there is no immediate profit or loss if you exercise it. Means we can say here in this is an option where exercise price is the same as the spot price of the underlying currency, that is to be said ATM, at the money. In the money, an option that would be profitable if exercised immediately is said to be ITM. An option in the money, when exercising it would result in a profit. For example, if you have a call option to buy the currency at lower strike price than the current market price, you will make a profit if you exercise the option. And out the money, an option that would not be profitable if exercised immediately is referred to as out of the money. Uh, an option is out of money when exercising it would not make a profit. If the current market price is worse than the strike price, you would lose money if you exercised it. Clear? Okay. Swaps. What are swaps and what are the types of swaps? What are the factors influencing the swaps? We will discuss. Okay. Just see what are swaps basically. Swaps. Derivative instruments. Okay. Derivative instruments that represents the agreement between two parties to exchange a series of cash flows over a specific period of time, that are called swaps. Now, what are the factors that influences the swap? What are the factors that influences the swaps? Instruments, objectives, or the repayment scenarios must have changed, may have changed. Increasing the financial benefit is switching to the newly available or alternative cash flow streams. The needy may arise to hedge or mitigate the risk associated with a floating rate loan repayment. And if we talk about the interest rate swap, an interest rate swap is type of a contractual agreement to exchange a series of cash flows, where cash flows at a fixed rate of interest are exchanged for those referenced to a floating rate. So in an interest rate swap, one party agrees to exchange fixed interest payment without another party that pays the floating interest payment. Floating means rate changes over time. There is no exchange of the principal amount, only the interest payment. And the size of the swap is based on the notional amount, means the reference value is used to calculate the payments. Clear? Currency swap is contractually similar to an interest rate swap, where cash flows of one currency are exchanged for the cash flows in the another currency. So, a currency swap is similar, but instead of exchanging interest payment, the parties exchange payment in the different currencies. This help in hedging against both foreign exchange risk and exchange rate risk is the same time. Then if we talk about the zero coupon swap, the zero coupon swap offers the flexibility to one of the parties in the swap transaction. So a zero coupon swap works like an interest rate swap but with a twist. One party makes no periodic payment and only pays a lump sum at the end of the contract. The other party continues making regular payment based on the floating interest rate. And in the fixed to floating zero coupon swap, the fixed rate party makes no payments until the end. Clear? And also, a fixed zero coupon swap involves one party making no interim payments while the other party makes regular fixed payments. Okay? Now, equity swap. What is equity swap? Okay, equity swap basically we can say is an exchange of the future cash flows between the two parties that allows each party to diversify its income for a specified period of time while still holding its original assets. It is an agreement between two parties to exchange the future cash flows based on the performance of the asset. And the basis swap, a basis swap involves a regular exchange of cash flows, both of which are based on the floating interest rate. In the swap, basis swap, both legs are calculated on the floating rates. So you can see it involves the exchange of cash flow based on different floating interest rate. One leg of the swap can be based on the SOFR, while the other could be based on the different floating rate. And these swaps are very useful when both parties want to exchange the cash flows based on different types of benchmark. Clear, everyone? Okay. That's why I take the separate class for our numericals, because if numericals are included in this class, that means the class will become very long. So I am talking for 1 minute because a lot of time is there. Okay, let's see. We are at the end of the chapter of our first unit. We are near the end. Okay. RBI FEDAI guidelines on the foreign exchange transactions. RBI, Reserve Bank of India, prescribed a lot of guidelines for the authorized dealers and also for how to manage the foreign exchange transactions. RBI is the central bank of the country and is responsible for everything. It has set the specific rules and the guidelines for the authorized dealers, how to handle foreign exchange and how to handle the foreign exchange transactions in India. And these all are things according to the Foreign Exchange Management Act and the FEMA regulation of 2000. Okay. Who can deal with the foreign currency? RBI issues licenses to the certain institutions to deal in the foreign exchange. These institutions are known as ADs, authorized dealers, who are allowed to handle foreign currency transactions. Okay. ADs, who are ADs? Basically two types of main categories of who having the license. ADs, authorized dealers, they are mainly scheduled banks, including public sector banks, foreign banks, private banks. They are allowed to deal in all type of foreign exchange transactions, including both current and capital account transactions. Also money changers, there are businesses that deal with the foreign currency notes, coins, traveler's check, primarily to assist with the foreign tourist. And this is also of two type, FFMCs. These businesses are licensed to buy and sell the foreign currency notes, coins and the traveler's check. These businesses are allowed only to buy foreign currency, not sell it. Okay. Let's see the categories of the authorized dealers. In 2006, RBI updated how dealers are categorized based on the types of transactions. These categories are authorized dealer category, first AD category 1. I'm just hiding myself. Okay. Basically what they do for the category first, they handle all the current and capital account transactions according to the RBI directions which is issued from the time to time. Example, commercial banks, state banks, urban cooperative banks, they are the top level dealers and are allowed to handle all types of foreign exchange transactions, which includes currency and capital account transactions. They include large commercial banks and the cooperative banks. They can deal with the international payments, foreign investments and trade related foreign currency transactions. And if we talk about the category second, those entities that can deal in the transaction of foreign exchange which are of non-trade nature. In this, regional rural banks can include it and other cooperative banks. These entities only handles the non-trade transactions which are not related to trade or business. This category includes cooperative banks, full-fledged money changers. These are the things included. These are the institutions included. Clear? Then authorized dealer category 3, those institutions that can deal with the forex transactions which are incidental, which are incidental to financing of the international trade related activities which are undertaken by these institutions. Example, Exim Bank, SIDB, these are the institutions. And full fledged money changer, purchase of foreign exchange and sale of private and businesses visits abroad, these are included in this. Sell uh, buy and sell foreign exchange for private and business abroad, this include FMCs and the other department of the post. Clear? And also for to preventing these type of issues, RBI set some types of guidelines also. Open positions will be there, gaps will be there, borrowing and the lending in the foreign currencies will be there, interbank dealings are there, like establishing the rules for how business can deal with each other. Hedging is also there, that banks and institutions hedge their exposure to foreign exchange risk, which includes their clients, whether they are resident or the non-resident. Now, FEDAI. FEDAI, Foreign Exchange Dealer Association of India. It is a self-regulatory organization which is formed in 1958 with the approval of the RBI to take over the functions that undertaken by the exchange banks associations on behalf of the foreign banks which are operating in India, in order to further the interest and the regulate the dealings of and between the authorized dealers in the foreign exchange, public dealing in the foreign exchange, foreign brokers, and also RBI, FEMA, IBI, and various types of other organization. So you can see self-regulatory organization established in 1953 with the approval of RBI. Primary purpose is to regulate and support the foreign exchange transactions in India. It took over the function previously handled by the EBA, representing the foreign banks operating in India. What is the role of FEDAI? Okay, what is the role? Non-profit body. It is a non-profit body that plays important role in maintaining well-regulated and orderly foreign exchange market, and acting as a facilitator between the authorized dealers and the RBIs in handling of foreign exchange transactions by the ADs, authorized dealers. Then also we can say issues the guidelines on various aspects relating to the foreign exchange. Okay, and articulating the effectively India's views point in various revision the ground rules like UCP, URC, URR, providing the training to member banks on foreign exchange matter, granting the accreditation to the intermediaries, monitoring the broking activities, administration of the benchmark rates. Clear? And also, like, very different things are this. You can see setting the guideline, regulating the merchant rate, managing the interest on default. Objectives of this: supporting the India's external sector, collaborating with the export promotion councils, developing the foreign exchange market, promoting the best practices, creating the uniform rules. These are the objectives. Role, I told you, issuing the guideline, advocating the India's positions, training member banks. Now, FEDA guidelines, rules relating to the dealing room operation. Rule 1 is hours of business. Basically, hours of business, normal market hours for transacting in is 9 to 5 p.m. on all the working days. Customer transactions and the transactions are all on the working days beyond normal market hours permitted for the cross currency transactions. Transactions with the persons which are resident outside the India through their foreign branches may be undertaken beyond normal market hours. And in case of individuals, transactions can be handled even on the Saturdays, Sundays, holidays as per the bank's internal policy which are subjected to. And banks ensures that such type of transactions are within the NOOP limits of the bank. Clear? Then second rule is export transactions, post shipment finance, purchase, discount, negotiation, bill buying rate, NTP, site bills. NTP is normal transition period. Application of the interest on the post shipment finance. Early realization of an export bill interest for the unexpired period. Bills that are drawn under the LC. In case of non payment of bills on the due date, crystallization of the foreign currency liability. And dishonor of the bills, export bills on the collection basis. These are included in this. Related to the export transaction, everything. Clear? Then rule 3 is all about import transactions. In this we can say in the case of import transaction, applications of the exchange rate, retirement of the import bills, bill selling rate, applications of the interest, bills under the negotiation under the LC's commercial rate of interest as applicables to the bank's domestic advances from time to time, and also the crystallization of import bills like unpaid import bills drawn under the LC's crystallized as per the bank's policy. Crystallization of import bills selling rate is there. Clean instruments. Clean instruments. In this we can include bank have an internal policy to convert in their INR up to the certain amount. Applicable exchange rate is TT buying rate. Compensation for the delayed payment, and in case of delay, interest 2% over the SB rate of interest to be paid for the delayed period. And here banks also liable to pay the compensation for the adverse movement. And in case the beneficiary does not respond within 5 working days from the date of credit to the Nostro, then in this type of case the guidelines are also there. Okay, like bank basically do not return the fund in this case. Bank crystallize the remittance. Transfer of funds between the Vostro account with two different banks. Okay, and foreign exchange contracts. In this, amounts are for the definite amount and for the definite periods. Option period of delivery shall not exceed beyond 1 month. If fixed date falls on a holiday, last date of delivery shall be the preceding working day. And in case of suddenly declared holiday, delivery falls on the next working day. And in case of collection document, date of payment of INR on realization. Clear? Rule 6. Early delivery extension and the cancellation. Customer here request for the extension for the cancellation before the maturity date. Cancellation and the rebooking simultaneously, and any profit or loss to be passed on, recovered to from the customer. Cancellation, recover, pay the difference in exchanging rate. Purchase contract cancelled as TT selling rate and the sale contract as TT buying rate. If contracts are not cancelled on or before the maturity date, banks automatically cancels the contract on the third day from the maturity date. and any losses are recovered and profits are not passed on. And where the reasons put forth by the client for the cancellation is beyond the control of the client bank as per their internal policy, and may pass the profits on cancellation even if cancelled after the maturity date. And in the rule 7, business intermediaries, exchange brokers, multi bank portals, and also the electronic order matching systems are some of the commonly used intermediaries which are used in the foreign exchange markets. Review of the intermediaries from time to time is to be done, and reporting to be made to FEDAI for any type of violations or acting contrary to the code. And also, all the contract confirmations should contain the clause that is subject to rules and the regulations of the FEDAI. Clear? Then rule 8, interbank payments and the settlements. Banks here to track the delivery of the funds, note dispensaries and the take up with the counterparty for corrective actions separately. Interest for the delayed delivery for the number of days at 2% over the benchmark rate of the currency. All banks should be registered with the CCIL, Clearing Corporations of India, and also time limit to claim is 15 days from the due date of the contract. I think I know these rules are boring, but what to do? We have to read the boring things too also. We can say these are the important. Okay, these are also important. We can't ignore. Now we will see the FX Global Code. Just give me a minute. Okay, then we will start. Just only 1 minute for the water break. Okay, just now let's start move further. FX Global Code. What is FX Global Code? A unique code across the globe, a unique code across the globe for the wholesale foreign exchange markets, which aims on the principle of good practices, engaging the local participants actively, promoting the healthy and disciplined dealing room, trading, and also all the things. Hong Kong Monetary Authority of Singapore, Bank of Korea. This is a set of principles and the guidelines which aim to good practices, healthy trading, risk management in the foreign exchange market. It has been endorsed by several global authorities, which includes RBI and the major institutions like Hong Kong Monetary Authority of Singapore, Reserve Bank of Australia, Bank of Korea, among others. What are the guidelines for the authorized dealer? RBI is issued some types of guidelines for the authorized dealers too. These guidelines are helping in managing the risk of these institutions and ensuring the smooth functioning in the forex market. Some key rules and the regulations for the ADs are here. You can see, like for the commercial banks, they can allow to open and close the non-bearing rupee account. Then investment AD bank category banks are allowed to invest in the foreign money market instruments. These instruments must have a residual maturity of less than 1 year. They can use the Nostro account surpluses. Forward contracts are there for the exporters and importers too. SMEs, small and medium enterprises, can book the forward contract to hedge their foreign exchange market, foreign currency rupee swaps, and cross currency options. Just read them. And also, I am telling you that if you need the if you need the PDF, just tell me, then I will give you. Okay. Okay. And also one more thing. The revised FEDI Code of Conduct, adoption and implementation in India foreign exchange is implemented with the effect from 1st of September 2021. Clear? And foreign currency rupee options are also entered into the by the banks with the customer on a back-to-back basis, but require here some RBI approval. Now it's time to start our LRS, a very short chapter and very interesting chapter. So let's start with the LRS, Liberalized Remittances Scheme. I think first chapter is clear to all of you. I tried my best to explain everything, and you know this is a marathon. In this we can only include the important topics and the bullet topics basically. So I tried my best to cover everything, and if you like, so kindly give the like. And today is we will complete this A D both. Okay. Okay. Within 1 minute we are going to start LRS. Okay. LRS, liberalized. We will speed up now little bit. LRS. It allows resident individuals to send money abroad for both capital and the current account transaction, but the businesses, partnership firm, trust and NRIs are not eligible in this case. And also, if I complete it, just give me a second. Okay. Basically, I think first this chapter exchange rate is little bit wide, but now chapters are in documentary credit or letter of credit is little bit wide chapter, but now chapters are small. In module D, capital adequacy for the Basel norm is little bit wide chapter, big chapter. But yeah, we try to wrap up this module A by 9 p.m. or 9:30 p.m. Then in next 3 hours we will complete module D, and we try to complete it by 12 p.m. or 1 p.m. Okay, and whatever the God wants. Now, okay, capital account transaction, a transaction which alters the asset liabilities, including the contingent liabilities outside the India, person resident in India, or asset and liabilities in India of person resident outside India. So it involves transferring the assets and liabilities between India and the foreign countries. If a resident individual invests in a foreign company, shares or buys property abroad, they create an asset outside India. Current account transactions including things like payment for the trade, loans, education, medical treatment, and personal expenses. For example, sending money to a child studying abroad for tuition or living expenses is a current account transaction. Okay. Now, some also key sections are there. uh, under FEMA for liberalized remittance scheme. In section 4, no person resident in India shall acquire, hold, own, possesses, transfer any foreign exchange or foreign security or any immovable property, yeah, situated outside India, and also unless it was acquired while being a non-resident. So you can see this, read this, this is written. Section 6, any person may sell or draw the foreign exchange to from an authorized person for a capital account transaction. The people This allows people to exchange foreign exchange currency with an authorized dealer for a permissible capital account transaction such as investment abroad within set limits defined by the regulations. Then section 6 is basically any person, I told this section 6, yeah. Now section 10, subsection 6 is here. Utilization of the foreign exchange availed from an authorized dealer for the purpose for which foreign exchange has been availed. And section 11 is saying RBI RBI may give to the authorized person any direction with regard to the making payments or basically failure to furnish any type of penalty. There is 10,000 of penalty, and continuing contravention additional penalty is there for 2,000. Section 13, if someone breaks the rules in the FEMA Act or its regulation, they may have to pay a fine. If the amount involved is clear, the fine could be up to 3 times that amount. If it is not clear, the amount will be 2 lakh, and if violation continues, then the additional fine will be 5,000 per day. Clear? Now, okay. Some of the simple explanation of the prohibited remittances under the LRS. Prohibited remittances. Margin, this is come under the Schedule 1. Non-permissible remittances. Schedule first. Okay. So, remittances for margin or margin calls, payment of commission on export made towards equity investment, payment related to the callback services of telephones, remittance towards banned or some kind of proscribed magazines, purchase of the any type of FSCCBs issued by the Indian companies, remittances of the dividends by any company, remittance of the interest income, remittance out of the lottery winnings, purchasing of the lottery tickets, income from the racing, riding or any other hobby, payment or commission on exports under rupee state credit route. These are prohibited under section 1. Then section 2, remittances towards the cultural tours, remittances in the foreign print media, remittances towards the freight of vessels, and also payment of imports through ocean transport, hiring charges of the transponders. In this, approval is required from the Ministry of Information Broadcasting and Ministry of Information Technology, and also remittance of prize money, sponsorship of sport activities, and activities which are abroad other than international, national, state level sports bodies, and amount that involve exceeds the US dollar 1 lakh. Okay. And according to the Schedule 3, these are permissible under the delegated powers of the authorized dealers. What? Private visits to any country other than Nepal, Bhutan, gift or donation going abroad for the employment, emigration, maintenance of the close relatives abroad, travel or businesses by the resident individuals, accompanying as attendant to a patient going abroad for medical treatment, expenses in connection with the medical treatment abroad, studies abroad, purchase of object of art subject to foreign trade policy. Clear? And other remittances are like health insurance also. Some of the operational guidelines, pen is necessary. You can here in this remit the funds up abroad for permissible current or permissible capital current transactions. Transactions are freely allowed up to US dollar 2,50,000. A remittance of 2,50,000 is utilized in a financial year. No further remittance is allowed. Any amount in excess of the LRS limit requires the prior approval from the RBI. Okay, and in the case of sole proprietorship, if a firm wants to remit the funds, the eligibility of the individual prior proprietor is considered. An international credit card, debit card, ATM card can be used for the current account transactions. Foreign citizens working or assigned in India for less than 3 years can also remit under LRS, and exceeding the amount need the RBI approval. Banks can verify the sources of funds, including the review, the customer bank statement or the tax return. In short, LRS allows residents to remit the funds abroad for the various personal purposes. What are the documentation which are required for the LRS remittance? First one is Form A2, a declaration form related to the FEMA. Documentation is required, declaration where the money is coming from, and PAN is required for all the remittances regardless of the amount. And then yes, remittances that under LRS for current account transaction, like private visit to any country, irrespective of the number of visits undertaken in a financial year, cash towards release of exchange up to rupees 50,000, beyond which transaction to be routed through the account, unutilized foreign exchange to be surrendered to the AD within 180 days from the date of returning to India, and gift to a person resident outside India, it is included in this. Okay, and also the donation. Emigration is what? When shifting to the another country, and in this case you have to need provide the documents. Going abroad for the employment under the LR, under the capital account transactions, medical treatment is here. But if in this case, if that limit is exceeded, so funds are available for this type of condition. Clear? Now, studies abroad, in this case also the limits can be exceed, but proper documentation should be provided to the company, to the company, not company, sorry, to the government. And students, those who are going abroad for the studies, are considered as NRI, and they can use the NRO account. Now what are NRO account, we will see further in upcoming slides. Okay, now TCS. What is TCS? This is starting from the October 1st 2020, 5% TCS is applied to the foreign remittances under the LRS scheme if this amount is exceeds 7 lakh in a year. Okay, like telling you, for if PAN or Aadhaar is not there, 10% is TCS rate. Educational loan only 0.5% is applicable. For non-LRS limit, TCS does not apply to the non-individual remittances. In short, TCS applies on the remittances under exceeding rupees 7 lakh. If the rate is higher, rate is higher only in the case when the PAN and Aadhaar is not provided. So you can see the calculations here. If a person who is a customer A wants to make remittance of 6,50,000, so no taxes will be collected because the amount is less than 7 lakh here. But that person wants to make remittance of now 9,50,000. Now 5% tax will be deducted on 9 lakh. Add them and just reduce the 7 lakh, and now 40,000 remittances again. So 5% is calculated on this because 7 lakh is already deducted. And if a customer B makes a remittance on same financial year, so 5% tax will be deducted. And customer C wants to make a remittance of 10 lakh, so here for the education purpose, that means 0.5% tax is deducted. Clear? Clear everyone? Now remittances to the IFSCs are here. Resident individual can invest in the securities within IFSC in India under the LRS. Investment should not be in securities issued by the entities. You can open a non-interest foreign currency account, and if funds remain idle in the FCA for more than 15 days, they must be sent back to your domestic INR account. Okay, some remittances under the LRS for overseas direct investments. In this, a resident individual can invest in the joint ventures, wholly owned subsidiaries. The investment can be in equity shares or compulsorily convertible preference share. Investments can be in either listed or unlisted companies, but limit will be the same. Some of the prohibited some of the prohibited investment that are real estate, banking business, in the business of financial service activities. Okay. Now, repatriation and the disinvestment. Earning must be repatriated within 60 days of being due. Disinvestment is allowed only after 1 year, and some no write-offs are allowed. Additional restriction: investment in the FATF non-compliant countries are prohibited. This joint venture, wholly owned subsidiaries must be engaged in the genuine business activities and cannot acquire step down subsidiaries. Investment should be within the LRS limit. If the funds come from other foreign accounts, the individual should not be on the RBI caution list, a banking defaulter, or under investigation by the authorities. In short, under LRS, residents can make direct investment abroad in the joint venture subsidiaries, but there are limits, restrictions on certain industries, and the conditions on the repatriation and the deinvestment process. So these are the required documents under ODI. First one is Form A2, then simplified documentation for the individuals, declaration of source of funds, PAN, Form ODI in respect of the wholly owned subsidiaries and the joint ventures abroad, and resident individual also submit share certificates, any other type of document as evidence within 6 months from the date of making the remittance. So these are the reporting requirements under the LRS. Basically, first one is required to upload daily transaction, date-wise information, reported to the XBRL platform, and nil report if no transactions occur on a particular day. So this will be uploaded on the daily basis, reported on the daily basis. And also one more thing, there is a loan resident individuals, loans by the resident individuals. Loans are is basically free of interest, minimum maturity 1 year for borrowers personal requirement or for the business purposes. But loans are not allowed for the chit funds, for the agricultural plantation real estate activities, construction of the farmhouse. Proceeds may be credited on the NRO account also. The loan amount shall not be remitted outside India, and repayment shall be from inward remittances or transfer from the NRO, NRI, FCNR accounts. Clear? Okay. Okay, so with this completed one more chapter, correspondent banking and NRI account. And let's start. What is correspondent banking? This is a practice where a bank is able to handle the business in another city or another country through another country through local banks there, the local bank acting as a agent and charges fees for the services rendered. Clear? So this is refers to the relationship where one bank provides services to another bank in a foreign country. The bank in the foreign country is called the correspondent bank, and it helps facilitate a variety of banking services like handling the wire transfers, processing the business transactions, collecting the documents for the bank. Essentially, the correspondent bank act as an intermediary, helping the other banks serve as customer in that country. For banks that do not have the branches in the foreign countries, correspondent banks provide a way to access international markets and serve the clients without the need to open their branches abroad. And this relationship involves mutual account between two banks or one bank having an account with the other, but it can also work without any account relationship at all. Clear? Okay, just now, why we need this correspondent banking? See, international trade is growing rapidly. Clear? International trade is growing rapidly, and businesses around the world are looking for the ways to expand globally and increase their wealth. Correspondent banks help by handling all the types of transaction, accepting the deposits and collecting the documents from the other banks in foreign countries. They act as an agent for their home country banks and providing the essential services without the need to open physical branches abroad. This is why correspondent banking becomes essential. It allows a bank in one country to provide the banking services in another country where does not have any type of branch. By using correspondent banking, banks offer the services to the international clients, expand their business abroad, and keep the low cost. For example, if I am sitting here and I want to do business in the US, so how I will receive the payment? With the help of correspondent banking, my bank where I am having the account, that I will talk to them, and then this type of banking is possible where I can receive the payment easily. That is the main work of correspondent banking. And this financial action task force also set some type of special rules for the cross border correspondent banking due to the high risk involved. And these rules require banks to apply the strict checks like the customer due diligence, enhanced due diligence, when working with the international partners. And also, bank should make sure that they report the transaction to the national authorities and avoid working with those banks that do not meet these guarantees. What are the functions of the correspondent bank? They are issues the services, issues the guarantees, account services, custodial services, clear house functions. This includes handling all the letter of credit claims, collecting the checks, providing the statement of accounts at the regular intervals. The bank may also offer credit to approve payments before receiving the necessary funds. Clear? And yes, correspondent bank handle the payment instructions from their client bank. The payment could be for the settling transaction between banks or for the customer payment related to the international trade. Payments can be made to the beneficiaries in the same country or abroad depending on where the recipient bank account is located. These are the other services which are offered by the correspondent bank: letter of credit advising, LC confirmation, arranging the buyer and supplier credit, banks acceptances. These are done by the correspondent banking. Now Nostro account, Nostro, Vostro, Loro account in the correspondent banking. Maintaining accounts with another bank is an important event, though it is not always required. These account helps in handling the payments, collections and the reimbursements in the local currency of the correspondent banks. So first let's talk about the Nostro account. It is a foreign currency account that a bank in home currency holds with a bank in the host currency. It means our account with you. Vostro account. Vostro account is when a foreign bank hold an account in the home currency. Basically, this is the reverse of the Nostro account. And this means your account with us. Loro account. A Loro account basically refers to an account held by the another bank with the bank where the relationship is happening. It is essentially a third party account, means their account with them. Loro is an Italian word meaning their, so a Loro account is essentially a third party account. Clear? Mirror account is a way for a bank to keep the track of its Nostro account. It is a shadow account that mirrors the Nostro account in the bank own books. It helps in reconciling the transactions and the balances. The mirror account is maintained in the two currencies, the foreign currencies and the home currency. Now let's talk about the SWIFT. What is SWIFT? This is a society for worldwide interbank financial telecommunication. Okay. This SWIFT is a global network that allows banks and the financial institutions about the financial transactions to securely send the messages about financial transaction. It is owned by the member banks and the leading provider of the secure financial messaging services worldwide, and SWIFTs connect over 11,000 financial institutions in 200 plus countries. And security is there and availability is 24 into 7. Cost effective and swift, built on three main values: excellence, community, and innovation. Clear? Services, banking and payment, trade finance, securities, foreign exchange, and the treasury, and over 5 billion messages sent annually. Swift is fast, secure, and reliable. Chips. What is chips? Chips is basically a major system, payment system in the USA, operating since 1970s. It is used by the banks to settle the US dollar payments, mostly for the large international transactions. Okay, and how it is work? It is works like chips in an automated system where banks send and receive the payment instructions throughout the day. Okay, participants, 49 banks are participants using the chips, and each banks is assigned with a unique code, a participant code, and UID for their account to facilitate the fast processing of the payments. Chips operates in the New York and mainly used for the foreign exchange settlement for the euro dollar transactions. FEDAI is an important US based payment system, operates since 1918. It handles domestic payments within the United States. It operates on a gross settlement basis, making each payment is settled individually. Unlike chips, which processes payment in batches at the end of the day, 9,000 banks are using this, and this handles a lot of payments: interbank transfers, commercial payments, security transactions. CHAPS clearinghouse automated payment, similar to the chips, but it operates in the UK. It handles the large value payment and the settlements. 20 member bank, 4,500 indirect members. Target euro payment system across the eurozone. It uses the real time gross settlement, means every payment is settled instantly. It is the main system for setting the euro payment across the eurozone. All banks in the eurozone using this target too. Clear? Are the things clear to everyone? If you like the class, just give the like to the class, and also you can do the comment that if you are liking or anything is feedback basically. And yes, do interaction. If you have any type of issue, just you can ask. Now this RTGC plus and the EBA systems. RTGS plus, German based payment system, provide real time gross settlement, and it is used by the 90 banks and focuses the euro payments in Germany and across Europe. Now RTGS and NEFT are in the India. Thank you, Sunil sir. So RTGC and NEFT in India, two main system. RTGS, real time gross settlement. Basically, this is used for the large transactions between the banks. It is called a real time because payments are settled instantly, managed by the RBI. Maximum amount is 2 lakh. Availability 24 into 7. Transfers are completed in the 30 minutes. National Electronic Fund Transfer, smaller transactions, used for the smaller transactions, operates throughout the day, works 24 into 7. Suppose digital payment, we do digital payments easily with the help of this, and this does not settle the payment instantly. It provides fast money transfers. Both are the very easiest and the faster for the people in India to send and receive the money across the banks, and it is paper. It is basically reduces the paper use. NRI. NRI is defined under two different definition. One is according to the income tax, and second one is according to the foreign exchange management act. Let's understand this. According to the income tax act, any individual considered to the resident in India. Two conditions are there for the Income Tax Act. According to the Income Tax Act, person is stays in India for at least 182 days. Clear? During the last financial year. But the condition too is that if the person stays in India for at least 365 days during the 4 financial years and at least 60 days in the most recent financial year. If both conditions are not maintained, one of the condition is not maintained or either of these conditions is not maintained, they are considered NRI. 182 days at least the last financial year, and in the financial year there is at least 365 days and 60 days in the last financial year. And if an individual stays in India for at least 120 days instead of 182 days, during the previous financial year has stayed in India for at least 365 days in the past 4 financial year, their income, if in more than 15 lakh, this income is taxable. Okay. Then RN resident but not ordinarily resident. For the tax purposes, a person is treated as RNOR in this 9 years out of 10 years stayed outside India, and also 700 days, less than 700 days in the last 7 years. Both conditions are considered in the case of RNOR. Clear? Now, deemed resident is an NRI who meets the following criteria. They have Indian citizenship, they do not qualify as a tax resident of any other country, they earn more than 15 lakhs from the Indian sources. This rules applies only to the Indian citizens, not PIOs. Okay. Now according to the NRI as per FEMA Act. First one, Indian citizens who are moved abroad for the jobs, businesses or the other regions with the intention of staying outside India for an indefinite period. ठीक है? Okay. Indian citizens who are working with the foreign governments or the international organizations such as UN, IMF or the World Bank. Indian government officials or employees of public sector organizations who are sent abroad for assignments by the government or posted to Indian diplomatic missions in other countries. They are considered as NRIs. Clear? PIOs are now those who are not Indian citizens, but it can at least one of these condition. First one, they were an Indian citizen in the eye of Constitution of India or the Citizenship Act. They belong to the territory that become part of the India after 15th of August 1947. They are child, grandchild or the great grandchild of Indian citizen or someone who met the conditions. They are the spouse of the Indian citizens. So basically these person who qualify any one condition are considered as a person of Indian origin. Overseas corporate bodies refers to an overseas company, trust or firm that is mainly owned by the NRIs. For a body to be considered an OCB, at least 60% of its ownership must be held by one or more NRIs. NRI bank account type and requirement. NRI can open various types of accounts. NRI account, NRO account, foreign currency account, and special non-resident rupee account. NRE account can be opened and maintained by the NRI. How to fund an NRE? Remittances are coming from the abroad. Currencies deposits during visits to India. Okay. Permitted credits, money transferred from abroad. Interest earned on the account. Income from the investments. Current income like rent, dividend and pensions. Permitted debits, you can withdraw from an NRI account for the local payments, sending the money abroad, transferring the funds and investing in the India. Okay. And other features and the benefits are there. Checkbook facilities, checkbook is there, full repatriation is there, nomination facility is also there, tax exemptions also there. Interest earned on the NRE account is exempted from the income tax, gift tax and the wealth tax. And POA is what? Just a resident relative can operate the account on your behalf with a POA, power of attorney, open an NRE account, repatriate the funds outside India, make gifts to a resident on the behalf of the NRI, transfer funds to another NRE account. NRO account, just give me a minute. Okay. NRO account, permissible credit and the debits. These accounts are the rupee account and can be opened and maintained by the person which are resident outside the India. Okay, these are the permissible credits. You can see invert remittance, legitimate dues, transfer from other NRO account, rupee gift loan from a resident. Permissible debit, local payment, transfer to another NRO account, remittance, repatriation, transfers to NRE accounts. Now this FCNRB accounts. Non-resident Indians and persons of Indian origin are permitted to open this, but with the category authorized dealer category 1 banks. Deposits are accepted here in any permissible currency, and NRI can open these accounts but only in the form of term deposits with a minimum of 1 year or for maximum 5 years. The deposits are in foreign currency and are repaid in the currency of issue along with interest in foreign currency. Now, what is the meaning of RFC? Resident foreign currency accounts for the returning NRIs. Basically, an NRI which is returning to India for permanent settlement has the option to convert balances in NRE into an RFC account. But all the permissible credits being like pension, superannuation benefits from the employees received in the FCs, proceeds of the insurance, claims on the maturity are allowed in the RFC account. Okay. Then SNRR account is basically is the account any person who are resident outside India having a business interest in India may open a special non-resident rupee account with an authorized dealer for the purpose of putting through the transactions in rupees, not involving any type of violations of the provisions of the act, rules and the regulations made thereafter. Okay, so is for individual who live outside India, that have the business interest in the India. Now, facilities to the NRIs to invest in the India. NRIs can freely invest in the shares and the securities of Indian companies. NRIs can also invest in the securities other than shares and convertible debentures. NRIs have been allowed to invest in India in various securities and schemes. And NRIs are allowed to invest in securities other than convertible debentures. These investments are regulated by the FEMA, which set the rules for how securities can be issued between India and non-resident individuals. Now, I am taking only the important things. Yeah, repatriation of sale proceeds from the property. NRIs and PIOs can repatriate the sale proceeds of their immovable property. The property must have been acquired in compliance with the foreign exchange laws. The amount repatriated cannot exceed the amount bought to in or to buy the property. And for residential properties, the proceeds can be repatriated for up to 2 properties. And NRIs, PIOs can repatriate up to $1 million per financial year from their NRO account. If the property was purchased while they were still resident, repatriation can happen only after 10 years. Commercial properties related to the business interest can also be acquired and repatriated subject to the laws of India. Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal, Bhutan, Macau and Hong Kong needs the RBI permission to acquire or transfer immovable property in India except for property on lease, that is for the up to 5 years. Okay. Now, other investments are also there without the limit. Repatriation basis, dated government securities, bonds issued by the public sector undertaking, shares in the public sector enterprises. Non-repatriation basis, NRI can pay dated government security, treasury bills, mutual funds, units of maturity, money market mutual funds in India, national plans, saving certificates. Now, loans against non-resident deposits. Non-resident can get loans in the India against their non-resident deposits. What are the condition? Purpose. What is the purpose for the loan? Relending or lending for others is not allowed. Agricultural or plantation activities not allowed. Investing in the real estate not allowed. There is no limit on the loan amount, but usual margin requirements applied. Loan can be used only in India and cannot be sent outside the India. And also housing loans for the non-resident Indians. Banks may grant housing loan to the NRIs for the acquisition of a resident recommendation in the India, but the quantum of loan, margin money and the period of repayment shall be same as applicable for the resident Indians. The loan amount shall not be credited to the HCNR or NRE account. and the loan shall be fully secured by the equitable mortgage of the property being purchased to be acquired, and if necessary also lien by the borrower's other assets in the India. Loan repayment can be made by sending money from abroad, by debiting the NRIFC and RB account, and by using the rental income. Okay. Okay. Clear? Now, one more important chapter, documentary letter of credit. Just tell me everything is clear to all of you. An important chapter is going to start, and then okay. Documentary letter of credit, DC or LC, can be signed by any authenticated instrument issued by the buyer's bank. And also here it is undertaking to pay the seller certain amount of money upon presentation of documents evidencing the shipment of goods and in compliance with other terms and the conditions. Letter of credit, also called a documentary credit, it is a common financial tool used in the international trade. It acts as a link between buyer and seller, ensuring that the bank guarantees the payment. And also, in this gives the seller confidence that they will receive the payment once they ship the goods. For buyers, the LC ensures they will only pay if the correct shipping documents are provided as whatever the agreed here. Okay. Letter of credit are especially useful in the international trade. Buyer and seller are come and they will do, because what I am telling you about this, like if there is a person, okay, buyer and the seller, they have the trust issue, that if I order the things, I get the things, if what happen if I not get the money. So for making this trust, making the things smooth, this LC is introduced. It makes the process more secure by ensuring that both sides fulfill their obligations. Sellers get paid for the goods and buyer receive the correct document. Okay, basically the parties which are involved in this are buyer, that is also called importer, applicant on whose behalf LC is opened, seller, exporter or beneficiary. Then opening bank means buyer's bank, who issues the LC. Then the advising bank, who act as an agent of the issuing bank and authenticates and advises the LC. Then the confirming bank, who undertakes the behalf of the and advises the LC, and nominated bank is also there, reimbursing bank is also there, included in the LC's party. Clear? Now these are the revisions. UCP 82 revision, where different things is first version of the UCP uniform customs and practices for the letter of credit basically, and it drafts it based on the draft from the 1929 and included the following types of ways. Okay, and UCP 61, first update to the original UCP rules. Then UCP 222 introduced several important changes. UCP 290, which comes in 1974, that in this nomination is introduced. The rules added more details about how to handle the situations. A new rule covered combined transport is there, and basically a new rule set the standard that document must be prepared within 21 days. But in the next one, UCP 400, here, a clear definition of transshipment was introduced. I am telling only the important things, because if we are going through the deep explanation, then the whole light will take in this. Okay, UCP 500, in this, instead of 21 days, 7 days is there. Banks have to examine these 7 days in the 7 days. Okay, UCP 600 is the current version updated to align with the ISP 98, where the new definitions and the interpretations are there. Removal of revocable credits are removed. Revocable credits means when the buyer make the changes without the consent of all the parties. Lost documents, new rule was added to cover the situations while when where documents are lost in the transit. Examination period, the maximum time for examining documents was set to the 5 banking days now. Document requirement and handling the discrepant documents that do not matched. Parties, I already told you what parties are involved in the transaction. Revocable LC is that LC in which the LC has not been used, documents not handed over in this case, and they can be changed or cancelled any time by the issuing bank. Irrevocable LC, where bank promises to pay the seller as long as the terms of the LC are met. Once issued, this type of LC cannot be changed or cancelled without the agreement of all the parties. In irrevocable confirmed letter of credit is basically who is confirmed by the second bank, usually the seller bank, and in this bank add its own promise to pay the seller in addition to promise made by the issuing bank. Transferable letter of credit allows the original beneficiary to transfer the LC either in full or in part to another party, and the second beneficiary can be another supplier or business involved in this transaction. Red clause of LC, when there is exporter is requesting to the seller that give the advance before shipping the goods, demanding the advance. This advance can be drawn from the nominated or the negotiating bank. The purpose of his advance to help the seller to finance the production or purchase of goods that would be shipped later. This is called red clause letter of LC. Green call letter of credit. Basically, this type of things are now rare. These types of things are not used. Green clause letter of credit is similar to the red clause LC, but it is in some type of additional requirement. Seller must provide proof that the goods have been warehoused. This provides extra security to the buyer because it ensures that the goods are stored safely before shipment. Sight LC, it allows the seller to receive payment immediately when they present the required document that meet the terms of the LC. They will receive the instantly payment. These LCs are also known as document against payments. usance LC, called as an acceptance LC, which involves a bill of exchange where the payment is delayed. Buyer bank accepts the bill and promises to pay at a future date. And these LCs are called document against acceptance. Deferred payment LC is similar to the usance LC, but instead of accepting a bill of exchange, the buyer bank promises to pay the seller at a later agreed upon date after the documents have been presented. Negotiation LC allows the seller to submit the required document to a bank and the bank negotiates with the buyer bank for the payment. If the buyer agrees to the terms, the bank pays the seller. This LC provides flexibility in terms of payments and the documents. Clear? Now, moving further. Negotiation LC. In this type of LC, the issuing bank promises to pay a bank that negotiates the document for a seller. This type of payment made only if the document meet the terms of the LC. And this type of LC can either be freely negotiable or restricted to a specific bank nominated by the issuing bank. Clear? Then back-to-back LC. This is an LC where a seller uses an LC received from a buyer to issue another LC in favor of a local supplier, allowing the exporter to procure the goods. This helps the exporter fulfill their commitment under the original LC without needing extra cash. Okay. This standby LC is like a guarantee that ensures the payment if the buyer fails to meet their obligation. It is not usually used for the regular transactions but instead protects the seller against the risk of buyer defaulting. If the buyer does not pay, the seller can invoke the stand LC to get paid by the bank. This type of LC acts like a guarantee. It is not used for the regular payment but protects the seller in case of the buyer fails to pay. If the buyer does not fulfill their payment or the service obligation, the seller can ask the bank to pay by showing the required documents like a statement saying the buyer did not pay. Revolving LC, when a buyer wants to order goods in multiple installments. Okay. There is. Okay. Now UCP 600. In 2003, the International Chamber of Commerce in Paris appointed a task force with the approval of the Banking Commission to revise this UCP 600. Okay. After over 3 years of work, the task force prepared a draft for the new UCP. The drafting here consists of the members from the task force. Basically, task force prepared a draft for the new UCP. The drafting group consisted of members from the 9 countries to held 15 meetings before finalizing the draft of UCP 600. Just give me a second. Okay. Basically, a consultative group which is made of 41 members from 26 countries are formed here, and the draft formed, and this draft is reviewed by the national committees which include ICC India, where the key issues were identified based on various ICC opinions, doc deck decisions, paper, court ruling, and more. This doc desk, which stands for ICC Documentary Credit Dispute Resolution Expertise, is one of the mechanisms which available for the parties involved in this LC to seek the resolution. And also, with these types of discussions, the draft of UCP 600 during its meeting approved on 25th of October 2006, and new guidelines are coming from July 2007. Clear? And in this, 39 articles are there, and if instead of 49 articles, all the articles are deleted, revised, unnecessary articles are deleted. 1 to 5 is deal with the definition, interpretation, independence of LCs and the underlying contract. 6 to 10s are for the availability, expiry date and place, obligations and issuing the confirming banks, advising the credits and the amendments. 11 to 17 are for the pre-advised credit, nominated bank, reimbursement agreement, complying presentation in the original document. 18 for the commercial invoice, then 19 to 27 transport document, 28 is for the insurance document, 29 to 33 is extension, tolerance, partial and installment drawing, and hours of presentation. 34 to 37 is for the disclaimers, and 38 to 39 is for the transferability and the assignment of proceeds. Then documents under LCS scrutiny crystallization. Here, first one is some of the presentations, document presentation is very necessary. The scrutiny of these documents under LC is crucial. Person who is reviewing the document must be vigilant and very knowledgeable. They need to assess whether the documents are consistent under the LC requirements and the other laws. And first one is the bill of exchange, being one of the most important financial document, and it is drawn by the beneficiary on the LC issuing bank. It draws upon the issuing bank to make the payment immediately if it is drawn at sight, or accept and pay on due date if it is drawn on acceptance or the usage basis. And there are some requirements here in this. Second one is invoice, important commercial document in trade prepared by the beneficiary to provide details about the goods being sold. It should include information on quantity, value, weight and total value. And then apart from invoice, there is also insurance policy, certificate, then certificate of origin. Certificate of origin is what? Like certificate of origin determines the country of origin of good. It must be issued and signed by an independent authority. And all other documents like packaging list, weight list, and evidence of import by the importer. And basically some of the risks which are related by the LCs are rejection of the documents and currency restrictions, non-acceptance of the documents. And also here are the responsibilities given of different uh, parties which are involved in this. First one is the responsibilities of the applicant responsibility. In this, applicant responsibility is like they provide clear and precise instruction how to issue the letter of credit and any amendments, avoiding the excessive details. They also indemnify the banks against obligation which is imposed by the foreign laws. Then issuing bank responsibility, the bank that has issued the letter of credit and it provided the reimbursement authorizations. It must amendments must be clear without any type of double ambiguity, and also issuing bank must carefully examine all the things. If the bank wants to refuse the document, it must do so within 5 banking days. And advising bank responsibilities, they can choose whether to advise the LC. If it decide to advise the LC, it must carefully check its authenticity. Confirming bank as responsibility. Confirming bank responsibility is like provide an additional promise to pay alongside with the issuing bank when to require document and presented as per the LCs. And also negotiating bank is there which examine the document according to the UCB or the international standard bank practices. Now what is this international bank? Just give me a minute. Okay. Okay, so I am telling you some one important thing is missing in this international standard banking practices. This basically for the examination of documents under the documentary credit, and it is important guidance. It provides important guidance regarding the examination of document presented under the LCs. Basically, what is the objective of ISBP? Encourage a uniformity of practice. Encourage a uniformity of practice, and also it provides the practices that should be applied by DCs, practitioners, helping to reduce any type of mismatch presentations. Okay, and also one more thing in this, the important terms I am telling you. Ex workers. Ex workers means they are classified basically into the 4 categories. What? Incoterms. Incoterms means these are applied to the contract of sale but not contract of carriage. They deal with the relationship between seller and buyer. Departure. Ex workers. And main carriage paid here CFR, that means cost and freight. CIF, cost, insurance and freight. CPT, carriage paid to. CIP are carriage and insurance paid. Now main carriage unpaid, that is FCA, free carrier. Here free carrier or FAS, free alongside ship. FOB, free on board. And also some of the changes which are done between the Incoterms 2010 and the 2020. So most of the changes are like delivery and terminal is replaced with the delivery at place. Cost and the structures of cost, security concerns are addressed in this. Okay, and the reimbursing bank responsibilities are they pay the claiming bank. Reimbursing bank must pay the claiming bank the amount requested provided it has received, and all the parties which are involved and governed by these uniform rules for bank to bank reimbursements. Okay, clear? Okay. and the beneficiaries has some type of specific rights and the responsibilities. They cannot rely on only on the contractual relationships, and banks do not take the responsibility for the authenticity of the documents. Any delays or the losses, errors in the translation, loss due to the events beyond their control, such as natural disasters, civil unrest, or the business closures, actions of the correspondent banks, regardless of who choose them, the applicant is responsible for uh, any third party charges. Clear? Now, facilities for the importers and the exporters. Let's try to cover now this chapter. Then our ECBs, role of ECGC, role of Exim Bank. Then small chapters are there. Now the chapters are small. So let's start with this. In India, export trade. In India, export trade and import trade. Export trade and import trade is facilitated by the DGFT. DGFT means Directorate General of Foreign Trade under the Ministry of Commerce. This sets the policies for the export and the import. The Reserve Bank of India oversees the financial aspects. Okay, now let's see. And RBI also uses its power under the FEMA, manages the foreign exchange rules, regulates the financing of internal trade to help the exporters to stay competitive. Clear? And International Chamber of Commerce is providing the global standards for the trade, including documents like UCP 600 Incoterms, which guides the trade practices, and FEDAI also works with the RBI to support the Indian foreign exchange market and ensures the compliance with the best practices. Authorized dealer also follow the rules and ensures that no restricted or banned goods are traded. IEC, every person every person, firm, company engaged in export import trade has to apply for and obtain an importer code exporter code number from the DGFT. Okay, and basically exporters of services need registration come membership certificate from the services export promotion council for the federation of Indian exporter organization. Software exporter have to register with the software technology park of India, and EDF. EDF, all the exporters of goods from India, whether in the physical form or any other form, required to be declared in the prescribed forms for the effect that affect the full value of the exports that will be realized within the prescribed period and in the prescribed manner. The prescribed forms are EDF and Softex for software exports in the non-physical form, and for the exports other than the software is in EDF form. Some of the exemptions you can see, these are the exemptions. These exports from the India are exempted from filling the export declaration form. free trade samples and the promotional material, personal belonging of travelers, ship stores, transshipment cargo, military supplies, gift valued up to 5 lakh with a declaration, aircraft engines and parts sent for repair, goods re-exported after being imported free of cost, defective or surplus imported cost, replacement goods exported free of charge, and also defective goods which are sent for repair and the import goods sent for the testing, replacement goods exports which are approved by the Reserve Bank of India. Some of the prescribed time limits for submission of export document. Exporter must submit the export document with the duplicate exchange control copy of the ADF form to an authorized dealer within 21 days of the export or the software form certification. And these documents are for the collection, purchase, discount and the negotiation. And dealer may accept the documents after 21 days following the RBI's directions. Clear? Now, for realization of the export bills, the amount that representing the full export value of goods, software, services exported shall be realized and repatriated to India within 9 months from the date of export. And where our goods are exported to a warehouse which is established outside India, as soon as it is realized, in any case within 15 months from the date of shipment of goods. And in case of special economic zones and basically units that are in the technology park, software technology park and the biotechnology park within the 9 months from the date of export. And if any is in any situation, they can grant the extension for the valid regions. Then prescribed method of payment here: bank draft, pay order, credit to the exporter bank account, inward remittances, foreign currency notes, travelers checks. For gem and jewelry in SG8, special economic zones, if the contract is specified it, Indian rupees for the transaction with Nepal and the Bhutan, and this is according to the contract. Some of the exemptions are also there. Exporter has a good track record. Authorized dealer may accept payment directly from the buyer via check or demand draft. Clear? Now, ACU it is established on 9th of December 1974 in Tehran, Iran by the UN Economic and Social Commission for Asia Pacific to promote the regional cooperation and the trade, and the basic goal is to simplify the payments between the member countries to reduce the foreign exchange use and cut transfer cost. Payment between UCU member countries are Bangladesh, Myanmar, Pakistan, Sri Lanka, Maldives, Nepal, Bhutan, Iran and India are settled in ACU dollar, ACU euro or ACU JPY equivalent to US dollar, euro or JPY. Now, facilities for the exporters of facilities, remittances that are connected with exports. See, in this what is include agency which is commissioned on the exports, reduction in the invoice value, refund of the export proceeds, claim against export, extension of the time limit, write-off of the unrealized export bills, effective date of realization is there. Agency can be remitted or deducted, what I am telling, and foreign currency accounts. And banks can approve claims against export bills as long as export proceeds have been realized and repatriated to India. Okay, foreign currency accounts, overseas foreign currency accounts. Nothing in this. Now read DDA. What is DDA? Exporters and importers who deal in rough and polished diamonds or diamond studded jewelry can open a DDA. Okay, can open a DDA, and with an authorized dealer they may meet these conditions. They must have a track record of at least 2 years in a diamond trade. They have an average export turnover of at least 3 crores. Each exporter can maintain up to 5 DDA for their foreign exchange transactions. Now let's talk about the EEFC account. Resident can open this account with the AD category first bank. This account is for those individuals or the businesses that earns the foreign currency, including those in special economic zones, software technology parks. Exporters can deposit up to 100% of the currency payments, and they are similar to the current account, do not earn any type of interest. AD category 1 banks cannot provide any type of loan or credit facilities based on the balances in the EEFC account. Now let's talk about the EDF waivers. Basically, exporters may avail EDF waivers under these scenarios. First one, trade samples and publicity materials sent free of cost, gift valued up to 5 lakh, goods imported free of cost, goods sent for repairs or replacement that re-imported, goods sent for testing with the plan to re-import, and special economic units exporting defective products. Eh, okay, and also status holders can get the here GR waiver certificates up to the 2% of their average annual export over the last 3 years. These exporters who are doing exporting in gems and jewelry can get waiving of 1 crore or up to 2% of their average annual exports. Pharma companies 8% of average annual export realization during the preceding 3 licensing years, and other categories of exporters should approach RBI through their AD banks for the issuance of EDF waiver. RBI introduced this scheme, export financing, in the 1967. This scheme is intended to make short-term loans, short-term working capital finance available to the exporters at international comparable interest rate. Finances that allows to the exporter to fund the need of procurement of the raw material. Okay, and also, while on the other hand, finance against export bills when the shipment is already made is called post shipment credit or post shipment export finance. RBI gives some types of general instructions to the banks on how to give export loans, but banks can set interest rate up to the certain limit following the RBI rules. Exporters may need financial help to buy goods or to get money after selling their products. There are basically two types of export finance: pre-shipment finance, also known as PCL, and post-shipment finance. This is loan given to the exporters before they ship goods, and this is the loan provided after the goods have been shipped to the buyer. Pre-shipment finance, also known as packing credit loan or the export packing credit, it is a working capital loan given to the exporters to cover the cost of buying, processing and manufacturing goods for the export. Clear? These loans can be used for all the expenses before the goods are shipped, packing, transportation and the labor charges. And to get this loan, exporter must usually have a confirmed export order or an export letter of credit. In some cases, the bank may allow the loan without requiring the export order or LC upfront. And when evaluating an export loan request, bank must follow the guidelines which are set by the RBI and this DGFT, the Export Credit Guarantee Corporation and the bank's own internal rules. Clear? The loan, which is usually based on the free on board, this is the value of good which is ready to be shipped when the goods of the ready to the ship, excluding the freight and the insurance. Post shipment finance. What is post shipment finance? See, post shipment finance is what? This finance can be of various types, like export bills that are purchased, discounted, negotiated, advance against the bills that sent on the collection. Also, advances against exports on the consignment basis, and advances against undrawn balances, advances against duty drawback. Telling you the things clearly. Basically, this is a type of a loan which is given to the exporter based on the money they are owed after the shipping goods. It involves handling documents, sending them to the foreign buyer, bank or the buyer, and collecting the payment. And in this, IEC code is required. It is monitor and increase the responsibility during this stage. Submission of shipping documents is also required here within the 21 days. Post shipment finance, rupee finance, the export bill should be purchased, discounted, negotiated after the bank's bill buying rate, and payment should be received in an approved manner and within the time frame which is set by the RBI. NTP starts when the export documents are submitted at the bank to the bank for the collection, and before granting this advance the bank must ensure that they have the authority to do so. Okay. And in this, yes, when goods are exported on a consignment basis, just okay. Okay, so when goods are exported on a consignment basis, they are sent abroad for approval and scale with the overseas agent or consignee responsible for selling them. The exporter takes on the risk for these goods, and the consignee sends money back to the exporter only the goods that are sold. The bank overseas branch is instructed to give a necessary document to the consignee based on the trust receipt. And also this must be done within the 9 months of the shipment, and if the goods are stored in approved Indian owned warehouses abroad, the time limit for receiving the payment extends to 15 months. Clear? Now let's talk about the export data processing and monitoring system. For better monitoring of export of goods and software, and facilitating the AD banks to report various returns through a single platform, the RBI has launched a comprehensive IT based system that is called export data processing and the monitoring system. And now the objective of EDM, EDPMS is to simplify the procedure for filing the returns on a single platform. Like handling of shipping bills for the caution listed exporters, delayed utilization of advances received for the exports outstanding beyond the stipulated period. Okay. Then we will talk about factoring and forfeiting. Okay, I am discussing here. Factoring is what? Factoring is defined as an continuing agreement between a financial institution and the business concern selling the goods or services to track the customers on open account basis, whereby the factor purchases the client book debts either with or without recourse to the client in relation there to control the credits that are extended to the customers and administrators the sales ledger. And this type of factor provides lots of types of services: debt administration, credit protection, factor financing. Okay, forfeiting is what? Is the purchase by the financer of medium term export claims to the buyers without recourse to the exporters. It is a source of finance and not a type of credit insurance. And no other cost other than financing cost are involved in these transactions. This is basically takes away all the political commercial risk, makes 100% finance available against the invoice drawn. This is without the recourse facility. Okay. Then yeah, this one, IDPMS. The working group has recommended development of robust on effective IT based system, that is IDPMS. Basically, primary data on the import transaction from the custom will first flow on the IDPMS server. Thereupon, depending on the AD code, shall be shared with the respective banks for taking the transactions forward. Then this AD bank will enter every subsequent activity, document submission, outward remittance data in IDPMS as to update the IDPMS database on real-time basis. Okay. So basically, it is a Reserve Bank of India formed a working group led by the Shri A.K. Pandey with the members from various types of organizations, and this is a group that suggested developing a system called the IDPMS. Okay, let me tell you about the trade credit first. Trade credit, in this, let's talk about the supplier's credit. It is a type of a financing which is provided by the overseas supplier of goods to an exporter. Just like in domestic market, international payment terms can either immediate or on credit. After shipping the goods, the exporter can get financing against the bills from their bank. They will receive funds when the payment is due, and the duration of supplier credit starts from the shipment date. And for capital goods, the credit period can be up to 3 years, and for the non-capital goods, it is limited to 1 year. Okay, banks can approve a maximum of $50 million for each supplier credit transaction. Same buyer credit, it is a type of financing that the importer arranges from a bank or financial institution. It is a way for the bank to get credit to make the import payments. And the payment is guaranteed by the bank of financial institutions as long as supplier fulfill the responsibilities according to the agreement. Okay. Okay, so let's start ECBs and the foreign investments in the India. What is the main goal? The main goal is to helping the Indian companies to get the extra funds from the abroad so they can make the factories, infrastructure like this. This is done while keeping control on how much money goes and out of the country. These are very popular because they allow the Indians business to borrow the money from other currencies where the interest rates may be lower, making it cheaper way to raise the funds. That is the purpose of ECBs. And okay, okay, these are basically type of the loans. And here companies can take it from the foreign lenders. Just these loans can be in the foreign currency, Indian rupees. They have usually the repayment period of 3 years. Some loans can be less than 3 years, depending whatever the rules of the RBI. Two ways to get the ECB's: automatic route, approval route. Foreign currency loans can be in any free convertible currency. It include bank loan, bond, debenture, trade credit, foreign currency convertible bond, foreign currency exchangeable bonds. Indian rupee loans can include the same type of loans and bonds as foreign currency loans. Who are the eligible borrowers? All the entities eligible. Startup recognized by the central government, registered entities involved in the microeconomic activities. These entities are only allowed to raise the ECBs. These entities: Port Trust, United SEZ, SIDBI, and Exim Bank. And the money raised through the ECBs cannot be used for these purposes: real estate activities, investing in the stock market, buying equity shares, working capital need unless the funds come from a foreign equity holder, general business expenses, repaying loan in Indian rupees, lending to others. ECPs recognized lenders. Resident of FATF, multilateral and regional financial institutions, individuals only permitted if foreign equity holders or for subscription to bonds debenture listed abroad, foreign branches, subsidiaries of Indian banks. Now, what is this minimum average maturity? I am just giving you the quick overview about this. Okay. Okay. What is MAM? 3 years, including borrowings by startups, manufacturing sector companies. 1 year for ECB up to US dollar 50 million or its equivalent per financial year. Repayment of rupee loans that is raised domestically uh, like uh, other than the capital expenses, and for the working capital purpose or general corporate purpose, that is of 10 years, and for repayment of rupee loans availed domestically, and here MAMP will be 7 years, and for non capital expenses this will be 10 years, and the for startups this will be 3 years. Okay, clear? Now, all in cost ceiling. All in cost includes rates of interest, other fees, expenses, charges, guarantee fees, ECA charges, whether paid in foreign currency or INR, not include any type of commitment fees or withholding tax payable in the INR. Okay. ECBs, other operational concepts, currency change, like borrower can freely change the currency of one ECB from one currency to another. Borrower must hedge both the principal and interest payment using the financial hedges. Eligible borrower can raise up to US dollar 700 million per year under the automatic route, and if the borrowing in foreign currency from a direct foreign equity holder, the ratio of ECB to equity cannot exceed 7:1. Basically, that is not much important. I am just telling you for this now, telling you the important things. Now, what are the reporting requirements? LRN, that is obtained from the RBI. The borrowers who are required to submit this form, the bank that forward the applications to the RBI Department of Statistics and Information Management and uses it and reviews it. Then borrowers have to report this actual ECB transaction every month, and the report must reach the RBI within 7 days after the end of each month. Any borrower who is otherwise in compliance of the ECB guideline can regularize the delay in reporting the payment of late submission fees, and the late submission fees may range from 5,000 to 1 lakh per year depending on the extent delayed submission. Clear? Now, conversion of ECP into equity, borrowing the company activity that is covered under automatic route of FDI. Conversion should be with the lender consent without any additional cost. Pricing guidelines that to be adhered. Credit facilities from the Indian banking system guidelines, which is issued by the RBI to be compiled with, including consent of other lenders. Then foreign investors. Wait a minute. Okay. Foreign investment, any investment in the equity instrument made by the person resident outside India and on also a reparable basis. Okay. Apart from this, this FIPB was abolished in 2019. Eligible investee entities are Indian companies that are defined under the Companies Act, then the trust, LLPs, specific investment vehicles, and the startup companies. Prohibited sector, lottery business, gambling, trading in TDRs, real estate business, construction of farmhouses, manufacturing of tobacco, manufacturing of tobacco, cigarettes, and sectors that not open to private investment, atomic energy, and the railways. Yeah, these are the rules for the NDI, non-debt instrument rules. Basically, uh, this 1 and 2 for the title and the definition, 3 for the investment restrictions for non-resident, rule 4 restrictions on receiving instrument, rule 5 for the permission for investment by foreign resident, rule 6 is the investment by for foreign residents, rule 8 employee stock options and sweat equity shares, rule 9 transfer of equity instruments, rule 10 investment by the foreign portfolio investors, Rule 12 is investment by NRIs and overseas citizens of India. These are the Rule 16, Rule 720, Rule 21, Rule 23, Rule 24 to 23. These are the different types of rules. Clear? These are the requirements, basically not that much important. Yes, now role of foreign trade, role of ECGC. Tell me first that till then anything is cleared. I mean, everything is cleared. Is this session is helpful for you? I mean, मतलब, I want to say after watching this session, you are feeling that this is okay, this is better. Anything? Just tell me in the comment part that if you are feeling that yes, helpful or not helpful or anything else you want to say, just say. Don't worry. But do comment, okay? That are very necessary. Now, risk in the foreign trade, role of ECGC. Any activity that involves any uncertainty that leads to loss or gain. International trade is no different and comes with risk like buyer risk, seller risk, and the shipping risk. These risks need to be carefully managed to reduce their negative impact and to help business achieve their goals, including maximizing the profits. International trade relies heavily on bank financing. Many countries have to set their ECGCs. ECGCs, that is known as Export Credit Guarantee Corporation of India, owned by Government of India, established in 1957. Its main goal to support exports by providing the insurance to protect against the credit risk related to the export. Operates under the Ministry of Commerce and Industry and overseen by the Board of Directors. Thank you, James, sir. Thank you. It includes representatives from the government, uh, Reserve Bank of India, banks, insurance companies, and the exporters. That is ECGC. Over the years, ECGC has developed various insurance products to meet the needs of Indian exporters and the banks that provide export credit. As an organization, focused on promoting export, ECGC help Indian exports stay competitive by offering them credit insurance that safeguard their payment. This supports the growth of exports in the country. And one more thing, any activity, any activity which may give profit or result in loss may be called as risky proportion. Clear? Why we need the export credit insurance in the international trade? Because export credit insurance provides the protection against the losses from political and the commercial risk to the exporters and the financing institutions. Countries have set up their special institution to provide the services of export credit insurance. In India, export credit is insured by ECGC, which is was set by the government of India to support the growth of export. So export payment are always at the risk, and event like war, civil war can stop or delay payments. Economic troubles, balance of payment issues in country might lead to the restrictions, and the recent pandemic has also shown how exporters can struggle to get their payment due to the health crisis in the importing countries. And also, what are the definition of risk and various types of risk in the international trade? It is an uncertain event that can have financial consequences, that is called risk. When an activity may lead to either profit or loss, it is considered risky because of the unpredictability of what might happen in the future. And this ECGC is a credit guarantee institution. Okay. And there are many types of risk that is presented in international trade: credit risk, legal risk, country risk, operational risk, exchange risk. In international trade, risks are higher because it involves different country. I don't know why this is shows like this in slide showing. There are the risk where currencies, commodities, and even interest rates. These are the risk. Okay, so buyer risk is when the seller faces risk like the buyer not accepting the goods, not paying, making the payment, not approving the quality. Seller risk is a type of risk when the buyer risk the seller not shipping the goods after receiving payment, sending the poor quality goods, or delivering the goods late. Shipping risk, this involves risk from other parties like shipping companies, port authorities, transporters. Goods could be delayed, mishandled, lost, delivered to the wrong place, or stolen. That is shipping risk. Other risk, credit risk, when the buyers is unable to pay. Legal risk, when there is a suit, penalty, ban on the certain goods or restrictions. And country or political risk, like political or economic changes in either country or can issues related to the exports. Operational risk, strikes at factories, internal failure. Exchange risk, currency fluctuation can lead to the losses. These risks are the natural part of international trade, but they can be managed through proper planning and by using the tools like export credit insurance. Clear? Now, country risk, in short, this is relates to the development in the country of the buyer and the seller, which leads to default in export or payment. Okay, and RBI issued guidelines how to manage the country risk, and bank have to create their own policy to deal with these types of risks. And ECGC rated the basically rated here the Seven risk categories are there: insignificant risk, low risk, moderately low risk, moderately high risk, very high risk. Now, export credit insurance in international trade. This type of insurance provide the protection against losses, protects the exporters from financial losses caused by political or the commercial issues. Countries have set special institutions to provide the services of export credit insurance. In India, export credit is insured by ECGC Limited, which was set up by the government to support the growth of export. That is export credit insurance in international trade. And ECGC role and products. ECGC have a lot of objective: encourage and facilitate the globalization, assist the Indian exporters in managing their credit risk, protect the Indian exporters in managing their credit risk, to facilitate the availability of adequate bank finance, and also to achieve the improved performance, to educate the customers. You can see insurance for the exporters, credit insurance for the banks, export factorings at the MSMEs, credit risk insurance, insurance for the banks. ECGC main policies for the exporters. Standard policies that basically provide cover for the exporters for the short term policies. These types of policies are like shipment, political risk, to cover only the political risk, to cover commercial and political risk both, to cover the commercial and political risk from the date of contract, and to cover only political risk from the date of contract. Standard policies covers commercial risk, political risk, repudiation. Okay. Okay, small insurance policy is a type of insurance designed for the exporter who expect to have turnover of rupees 50 lakhs in the next 12 months. And the policy is issued for a period of 12 months and covers shipment that may be made over the next 24 months. It also protects against commercial and political risk. Now, type of wire-wise policies, like commercial and political risk. Political risk covers only political risk related to the exporters to the specific buyer. And buyer bias policy in this insolvency and default of LC, opening bank, and the political risk. In summary, these short-term buyer wise policies help protecting exporters from potential losses due to issues with these specific buyers. Okay. Buyer exposure policy is especially designed for the large exporters to enable them to cover their exposure on a particular buyer on the basis of expected exposure. Types of policies are there: specific buyer policy, all buyer policy. Exporters can choose coverage for non-LCs and LCs transactions. Each policy is valid for 12 months and covers all the exports to the specified buyer during that time. Clear? Okay. Now moving forward. Packing credit insurance. What is this? Any loan that is given to the exporter. Any loan that is given to the exporter to manufacturing, to processing, to purchasing, or to packing of goods meant for export against a firm order or letter of credit qualifies for the packing credit guarantee. And it is issued only for 1 year. The claim is payable in the case of pre-shipment credit granted is not paid within 4 months from the due date of the loan. And this export credit insurance for the banks issued by the ECGC to bank to where in a higher percentage of cover is available at lower premium, since a large volume of business is offered to cover in this guarantee. Bank have to notify this ECGC of the loan limit they have approved for their exporter customers within 30 days. If they want to exceed a specific amount, they need the ECGC's approval. The premium rates and the coverage may vary from one bank to another and are determined during the annual renewal of the guarantee. Now, post-shipment export credit insurance is what? A bank or the financial institution dealing with the foreign exchange is eligible to obtain whole turnover cover for all its accounts. The period is 12 months. The insurance here protects banks from losses that may be occurred in the uh, extending post shipment advances due to the default or the insolvency of the exporter's client. And the bills that are drawn on associates of policy holder coverage is 60%, and the non-policy holder it is 50%. And the premium of WTPS insurance is borne by the banks. Okay, it is also issued by the ECGC in the nature of a counter guarantee to the bank against possible losses that may suffer on account of the guarantees issued by them on behalf of its exporter clients. And here guarantees are necessary for the various types of regions, such as ensuring the exporter meet contractual obligations, and guarantees are to be required to be issued in favor of overseas buyers. Then this export finance is what? It is a bank. If a bank financing an overseas project provides a foreign currency loan to the contractor, it can protect itself from the risk of non-payment by contractor by obtaining the export financing guarantee. Then some of the things under ECGC policy: validity of the policy, maximum liability, advance premium, wholesale turnover policy cover, list of the buyers on whom ECGC has passed adverse experience, approval from the ECGC, declaration on or before 15th of every month, initiating the promote and necessary recovery actions, and also not enter in any type of compromise settlement or offer discount without the prior approval of ECGC. Everything is mentioned in this. Now, claims within 12 months from the due date of the unpaid bills and ensuring that the premium on their policies are up to date. Exports can submit the claims within 12 months. And these are settled by the ECGC for more than 4 buyers during the policy period. Claims will be paid directly to the bank who had handled the export documents. Bank can appropriate the claim amount directly to the post shipment advance document. And settlement of claim amount by ECGC does not relieve the exporter of the responsibility of realizing the proceeds, and all the further recoveries to be shared with ECGC on a pro rata basis and as when received. Now, next chapter, and also give me a minute. Okay. Now let's see the roles of the Exim Bank, RBI, Exchange Control in India, FEMA, FEDI and others. Okay. Exim Bank, which is established in 1981 under the Import Export of India, main institution for providing the financial support and the services for export import trade in India, especially for the long term projects. Now, in this, what happened? It coordinates with other types of institutions, and it basically play a very important role, and it makes the Indian export internationally very competitive. It develop alternative financing solutions. It provides the data, information and the advice. It provides selective production, marketing and financing, and it respond to the export problems. Okay. And basically we can say in the fast changing global financial environment, it act as a crucial player in promoting the cross border trade and the investment, to make the Indian export globally competitive, to develop the innovative financing solution, to provide the data, information and advice to Indian exporters on new export opportunities, to support the selective production, marketing and financing, make Indian export competitive in international market, to address the challenges that is faced by the Indian exporters and work toward policy solution to resolve them. What are the products of Exim Bank? Buyer's credit. Then it is a financial program that help ex- Indian exporters to explore new markets. This means the overseas buyer can pay later, and through this, an overseas buyer can open a LC in favor of an Indian exporters, which allows them to export goods and services from India on a deferred payment basis. It also helps them to stay competitive in the global market while continuing to use their working capital effectively to grow their business. And also, second is the corporate banking. Exim Bank offers various financing products in this, like research and development, pre-shipment, lending program, import finance program, production equipment finance program, lending program for the financing creative economy, finance for the grassroots enterprises, Lines of credit is saying Exim Bank offers lines of credit to help the Indian exporters so they can enter into the new markets. These are very effective way for the Indian exporters to enter into the new market. Exim Bank provide these LOCs to overseas financial institutions, regional development banks. This allows buyers in those countries to import the infrastructure projects. This also offers LOCs both on its own with the support of Government of India. And it enhances the export opportunities. It also encourages and facilitates the conditions for the Indian companies. What overseas investment finance. Project exports are also important because they are very playing the important role in promoting the project exports from India. They support projects that contribute to the development of the host countries. These banks provide the assistance to project export activities. This covers civil engineer projects, mechanical and electrical installations, supplying the material, consultancy, the services, technical know-how and technology transfers. Okay. Exchange control on India introduced before World War II due to shortage of foreign exchange. This was done under the Defense of India rules. In 1973, these rules were revised and become the Foreign Exchange Rules Regulation Act. And with the liberalization of the economy, FERA was eventually replaced by the new law. The Foreign Exchange Management Act come into force on 1st of June 2000. FEMA, FEMA which is passed by the Indian Parliament, come into the effect under on June 1st 2000. And also before FEMA there is a FERA Act, which FERA is replaced by FEMA. And in this, all the things related to the external trade, how to external trade is means external trade is become very easier in through the FEMA. FERA was little bit restrictive, but under FEMA violations are handled under civil law, and while under FERA they were treated as criminal offences. ODI is a single form introduced by RBI for all overseas investment in the joint ventures. In this, application for the allotment of unique number is there, and once unique number is issued, then this must be used for all the future communication by the AD and the Indian party. And part second is annual performance report, then report on the disinvestment. Now exchange currency, these foreign currency accounts in India, it involves residents including individual companies and the firms that can open and manage the exchange earner foreign currency account to conduct the foreign exchange transactions. When someone receives foreign exchange, they have the option to keep 100% of the amount. This account works like a current account and there is no limits on withdrawing Indian rupees. RFC account is already discussed in the first chapter. DDA is already discussed. Now about FEDAI. FEDAI is also discussed, right, in the first chapter. Rules is also discussed, sorry. Okay, so now already I target that I will complete module A by 9, but it's 10 already, but no worries, we will complete. Now we are on the IFSC, Gift City Technology in the International Banking. Now After this, one chapter is also left in this. Then finally we will move to the D module. And now let's do. Okay. Banks that are in international financial services centers operate as a foreign banks in their home country, meaning they are not required to follow the local rules. They can take the deposits from the non-residents citizens and provide loans only to the non-residents. The main goal of IFSC is what? That is International Financial Service Center. It builds strong international connections and meet the financial needs to be on the Indian economy. Basically, here what I want to say, an IFSC caters to customer outside the jurisdiction of the domestic economy. Such centers deal with the flows of finance products and services across the borders. Now, India has several types of, just give me a minute. Yeah, India's has SEZ Act of 2005, and IFSC can be set up with an SEZ. And India has several restrictions on its financial sector, such as limits on foreign investment and strict reserve requirements. This can be used to test new financial reforms before they are implemented across the entire country. With these global objectives, some gift city, Gujarat International Financial Technology, it began operations on December 5, 2019 with 225 companies, including 3 public sector banks, 9 private sector banks, and 3 multinational banks. What are the opportunities that are available at Gift City? They can access to the large hinterland economy. They are the gateway to the international market. They are the opportunity to connect India 30 million uh, strong diaspora worth US dollar 3 trillion, serving as a hub for both incoming and outgoing international financial services, potential to become a top destination for global in-house centers and attract the global talent to Gift City, and emerging as a leading center for fund administration. So you can see wholesale banking, capital marketing, retail banking, what are included in this. See, just give me a minute. In this, ECBs, trade finance, services like factoring, forfeiting, guarantees, equipment, insurance, involvement, participating, merchant banking, funding alternative investment funds, custodian service, being traded and the clearing member of exchange. And in this private banking, retail product like structured deposit, certificate of deposits. Now, treasury management in this ALM, managing the derivatives in the Forex, group level derivative trading, and other opportunities are including like trustee and fiduciary services, investment advisory. These are the things that are available in this. And please kindly give me 2 minutes. I will then discuss this. Just 2 minutes, okay? Okay. What are the guidelines for setting of the IFSC banking units by the Indian banks? Indian banks, both public and private, that are allowed to deal in foreign exchange can set up the international banking units. Each eligible bank can only open one IBU in each IFSC. Okay, and bank must get the prior information permission from the RBI before opening an IBU. IBU is treated as the foreign branch of the Indian bank for most regulatory purposes, and the parent bank must provide a minimum of US dollar 20 million to its IBU, and this capital must be maintained all the times. Reserve requirements are there which are exempted from the CRR and the SLR, and funds for the RBU will come from the non-residents. These funds can be lent to both people living in India and outside India. IBU cannot handle the cash transactions, and deposits can only be held in current accounts or term deposits. KYC rules are applied. Deposits with the IBUs are not insured. What are the role of this? These are basically developing and regulating all the financial product services and the institutions in the IFSCs. Separate regulators are there like RBI, SEBI, PFRDA, IRDA. They all are managing the activities in IFSCA. IFSCA. Established on 27th of April 2019. Act within the headquarters Gandhinagar, Gujarat, and it manages the financial services which require the coordination between different regulators, and the main goal of this to strengthen the global connections which make the economy stronger and also act as an international financial hub for the global market. Clear? Okay. Then permissible activities are IBUs are transactions with the residents and the non-residents, transactions in currency other than INR, dealing with the WOS, wholly owned subsidiaries and joint ventures, not allowed to open SB accounts, foreign currency accounts of unit operating in IFSCs, and of non-resident institutional investors, corporate borrowers, subject to the FEMA and escrow account of Indian resident entities, no check facility for holders of current accounts, and operate and maintain the balance sheet, not allowed to deal in the Indian rupees, not allowed to participate in the Indian domestic call, notice, term, forex, money, and the any onshore market, maintain the SNRR also. And other than this, there is what I can told you in this. There is nothing to this chapter is that much important. Okay, now let's talk about the technology. First, banks are rethinking about their customer experiences. They are developing the efficient operating models. Basically, building a truly digital bank. For the truly digital banks, when the making bank more relevant to customers, relative benefits of speed, in-house talent, developing the digital ecosystem and the platforms, becoming proactive and agile, self-assessment and driving team network. Basically, many banks are redesigning their technology system to support new advancement, especially in digital banking and international banking. And bank detail, digital re-engineering plans are making the bank more relevant, balancing the speed and talent, building the digital ecosystems, organizational readiness, and being proactive. What are the evolution? In this, most of the banking activities were done manually because the population has a low literacy rate. In 1969, the government nationalized 14 banks to make banking services more accessible. While many people needed loans, they often could not reach the banks, so they turned to the financial intermediaries who charged higher interest rate for the loans. What are the benefits of technology? Accuracy is there, speed is there, lower cost, ease of doing business, compliance is there, reduce the workforce, better management information, business continuity is there. But limitation, infrastructure cost, technical issues, customer awareness is important, withdrawal and deposit limits are there, customer services, and the security risk is there. Inward remittance online, digital platforms. This is type of a online portal for receiving the money from the abroad. NRIs can transfer the money from their current country or any overseas bank in FATF compliant countries to any bank in India. What are the steps for NRIs to transfer the money? Registration, entering the details, and the transaction. What is the benefit? Quick transfer, fair exchange rate, 24 into 7 support. Outward remittance, this is a fast and easy online portal for sending the money abroad. Clear? And steps for sending money: login, add beneficiary, start payment, control limit, check status. Fast and easy, secure, permitted purposes, direct transfer, compliance, and also trade finance portal, web based online portal for handling all the international transaction such as import and export. And this trade finance portal allows customer to start, verify, and authorize the trade transactions. What are the features of trade portal? Import and exports. Okay, the portal supports all the traded transactions related to the exports, related to the imports and exports and post shipment financing. What are the benefits basically in this? Easy transaction, bulk uploads, online approval, easy access to documents, limit information, user friendly dashboards are there. Clear? Okay. Foreign exchange rate portal, basically what is this portal? This offers the corporations that meet the specific criteria to access its services after receiving a login and ID password which follows the internal guidelines. What are the key features of this portal? Real time access, document compliance. Corporate must submit the required document for their transactions. If they fail to do so, the bank will automatically execute the deal and recover the loss through an indemnity agreement. Benefits of using the portal: seamless interaction, competitive rates, real time codes, tracking is there. You can track also. Now, EDPMS is already done with by us. This is already done. Why we just see the fintech now? What is fintech? It is a combination of finance and the technology. It includes software, services, businesses that uses the technology to make the financial processes easier, more efficient, and often changing the traditional ways of doing things. Essentially, fintech is about digitizing financial services like credit unions, investment banking, and other parts of the financial industry. Clear? Artificial intelligence and fintech. Artificial intelligence means that everything that basically mimicking the human intelligence that works like humans to solve the problems, especially in the banking. For better customer identification we can use the AI. For improving the business sourcing we can use the AI. For enhancing the trade negotiation we can use the AI. Understanding the customer needs we can use the AI. But client business intelligence, credit risk scoring, fraud detection, we can use the AI. Data analytics help businesses in international trade, which create the new portfolios by using the past data to analyze the trends. It looks at which regions are more prone to price changes, which countries are politically stable, and those with strong infrastructure. Basically, big data analysis includes customer data, market data, customer preferences and spending habits, predictive analysis, market strategies, fraud detections, RPA, robotic process automation, which involve robots to handle the repetitive task instead of humans, making workflows, financial institutions more efficient. Means some common use of RPA include statistics and data collection, managing the regulatory compliance, communication and marketing is necessary, and also the transaction management. Now blockchain means how to store the information, which is very impossible to change, to hack or to cheat the system. This is the technology that is very popular because it stores transaction records and the sensitive data. Blockchain has made significant improvements in international trade finance. Some of the benefits of the blockchain technology includes that changed the trade finance in way similar to how the internet changed the media industry. It offers a very secure and clear way to record the transactions. Blockchains can operate without the need for a third party, making it more economical, and it keeps a lasting record of all the trade transactions, creating a reliable audit trail. Okay, overall, blockchain is a very powerful tool for improving the efficiency and security of financial operations. Okay, just give me a minute. Okay, and also in whenever a contract is done, credit establishing a documentary credit, we need contract, request, issuing and verifying, shipping and submit documents. So these are the things basically in which buyer and seller sign a commercial contract. Buyer requests the bank to open a documentary credit. The buyer bank issues the documentary credit and notifies the seller or their bank, and then the seller bank verifies the authenticity. The seller ships the goods are as agreed in the contract, and then seller gathers the documents listed in the contract and submits them to their bank. Advantages of using the blockchain technology: real-time review, transparent factoring, and with blockchain bank can facilitate the trade finance, reduce the counterparty risk also. And now this IDRBT, which is a part of Reserve Bank of India, has recommended a gradual adoption of blockchain technology. Banks can start by using private blockchain system for their internal operation. This helps in training the employees in the new technology and also improves the asset management and cross-selling opportunities. And now the challenges of fintech. Challenges are in the fintech regulators are basically doubts for the financial regulators, data security. Regulators worry about the data security due to the risk of hacking. It is important to safeguard the sensitive information of consumers. Obviously, if there is a data breach, it can lead to serious consequence for a company, which damaging its reputation. And also, starting a fintech company can be expensive. And also here, the direct human interaction can be decreased, but can't completely ignore. Okay. So, with this, we have completed our module A, all the important things from the module A. Before starting the module D, just tell me that everything is clear in this. Any problem, any issue if you are having, just you can tell me that everything is it is helpful for you or not. Just you can do the comment, because I think there is 4 continuous hours of I am speaking continuously, but yes, all this will perfect if everything is good in this. Okay, so I am sharing the module D PPT with you. Just give me a minute for this. And also need the PDF, just give me the comment, I will provide you the PDF too. Module D, balance sheet management. Let's see balance sheet management. What is balance sheet management? Basically 6 chapters are there in this balance sheet management. Okay, first chapter is on components of assets and the liabilities in bank's balance sheet and their management. Okay, asset and liability management in banks are very important, because they involve how to create long term plans, how to develop the profit. These tasks has been handled by the treasuries and other financial institutions. And also, these groups are given significant authority how to adjust the mix of assets and liabilities and play the role in how to eliminate the activities that does not align with the institution business strategies. Okay. What are the components of the bank balance sheet? It prepares balance sheet, profit and loss at the end of the each financial year according to the Banking Regulation Act. And the Government of India established specific formats on these reports. A lot of formats are there. But Government of India established some specific formats for these types of reports. Okay. Here is the simplified breakdown in this capital, reserves, deposit, borrowing, other liabilities, and the provisions are included in the sources of funds. What is capital? Which represents the owner's stakes in the bank. The Reserve Bank of India sets the minimum capital requirement for both domestic and the foreign banks through the capital adequacy ratio. What are deposits? These are the primary source of funds for banks that are categorized as below, like demand deposit, saving bank deposit, term deposits. Other liabilities and provisions. Liabilities are grouped into 7 categories: bills payable, inter-office adjustments, interest accrued, and others. What are the components of assets? Cash and balances with the RBI. Okay. Basically, these are the most liquid assets. These can be changed in cash very quickly. Like cash in hand, balances with the RBI, investments, one of the major assets of the bank's balance sheet. These investments include government securities, approved securities, shares, debenture, bonds, stakes in subsidiaries, or joint ventures. Okay. Just give me a minute. Okay. Banks invest in these security to meet the SLR requirements which are set by the Reserve Bank of India. Okay. Now, uh, advances means the advances represent the credit extended by the bank to its customers from form a major part of the asset for all the banks, thereby becoming the major source of income for the banks. Okay. And in this we can say like cash credit, overdrafts, loans repayable on demand, term loans are there, bill purchased and discounted, secured and unsecured advances are there. Secured, these are the loans that are backed by the tangible assets, and unsecured, they do not have any type of collateral or the security. The remainder of the items on the asset side of a bank balance sheet are categorized as other assets. Okay. And it include interest accrued, tax paid in advance, tax deducted at source, stationery and the stamps, and also Contingent liabilities. What are contingent liabilities? They are potential obligation a bank may have in a future. They include commitments like issuing the letter of credit, guarantee, and acceptance on behalf of the customers. Other examples are claims against the bank that are not officially recognized as debts, or the liabilities for partly paid up investments, and the outstanding forward exchange contracts. These are the contingent liabilities. And bank's profit and loss account, if we talk about, it includes income, and income is also divided into two categories. That P&L is divided into two categories. Then first is in income and expenses. Now this income is divided into two categories. First was in interest income. That is a primary source of revenue of banks, for the banks. It includes interest, discount, or advance bills. Other income like commission, profit and sale of investment, profit on revaluation of investment, profit on sale of asset, building, and other assets. Expenses. The expense side of the profit and loss includes basically interest, operating expense, provisions, and the contingencies. Interest expenses are here primarily related to the funds raised to meet the credit demands. This includes interest on deposit, interest on RBI interbank borrowing, and others. Operating expenses, that means the costs that are involving in how to running the bank. It includes payment to employees, rent, taxes and utilities, printing and stationery, advertising and publicity, depreciation on the property. Provisions and the contingencies include bad and doubtful debt, diminution in the value of investment, transfers to the contingencies. What is ALM? What is ALM? It is an act of planning, acquiring, and directing the flow of funds through an organization. Banking involves identifying and handling various types of risk, and ALM provides important role in this. What is the importance of ALM? ALM is required to match the assets and the liabilities, and also to minimize the liquidity as well as market risk. Clear? And asset liability management can be performed on per liability basis by matching a specific asset to support each liability. Clear? Now, objective of ALM are price matching, liquidity. What is price matching? Basically aims to maintain spreads by ensuring that the deployment of liabilities will be at a rate higher than the cost. And liquidity is ensured by grouping the assets and liabilities based on their maturing profiles. Clear? And it is essential for managing net interest income and net interest margin here, which is defined as net interest income divided by average total assets. Okay. What is the integrated approach? ALM is more than just managing individual categories of assets and liability. It requires holistic approach, making the simultaneous decisions about the types and amount of fixed assets and the liabilities that the bank holds, the mix and volume of these financial components. What are the key features of ALM? Coordinated management, flexibility, risk management, ongoing monitoring, and the dynamic adjustments. Why do we need ALM? Even if a financial institution has enough assets to cover its liabilities, timing is the key. 50% of the liabilities are due within 1 year, but only 10% of the assets are due in the same period. Due to this, an institution face liquidity crisis. This means it might not have enough cash available to meet its obligation. And ALM process typically involves several types of steps: reviewing the interest rate, examining the portfolio, assessing the credit risk, performing performance review. NII, this is the measure the impact of volatility on a bank short-term interest profit. So interest income minus interest expenses, that is net interest income. Economic equity ratio measures the proportion of shareholder funds to total assets. This ratio helps in assessing a bank's ability to sustain itself and indicate the balance between own funds and total funds. ALM as a coordinated balance sheet management. Stage first is specific balance sheet management functions, that is asset side management. It includes the reserve position management, liquidity management, investment security management, loan management, fixed assets management. And the liability side management includes liability management, long term management, capital management. Okay. And if you want to achieve this objectives, okay, so spread the management, maintain the difference between the interest earned and interest paid, loan quality, which ensures that of are high qualified to minimize the revenue scores, and also tax management, capital adequacy, controlling the non-interest operating expenses, and also generating the fee income and the service charges. Interest rate risk management. Okay, so give me 2 minutes, then we will start this chapter. Give the 2 minutes break. Only in 2 minutes we will start. Okay. Okay, so we will start at 20 10 10:25. We will start at 10:27. Okay. Okay, now let's complete. Let's start our new chapter, that is interest rate risk management. Okay, so if we talk about the 1950s and 60s, bank primarily worried about credit and liquidity risk, and with the deregulation of the banking system in the 1970s, many banks found themselves unprepared for the interest rate that is suddenly emerged. Okay, and poor management of these risks led to the several banks failure. In the 70s, 80s, 90s, several banks failed. Okay, just a minute. And now many banks are funding the term for long-term loans with short-term deposits, which worked well as long as interest rates were controlled. What are the essential of interest rate risk? When the bank has long-term assets which are funded by the short-term liabilities, which rising the interest rates can lead to a bigger drop in the market of those assets, which are compared to its assets. This mismatch can put the risk at bank the risk at economic losses and even insolvency. Interest rate risk can causes the fluctuations in the NII and in the NIIM. It arises from holding assets and liabilities with different amounts, maturity dates, and repricing dates. If to manage these types of risk very effectively, banks need to maintain it within safe and acceptable levels. And many banks recognize interest rate risk as a challenge to the profitability and are actively assessing how much risk exists in their balance sheet. This risk is generally categorized into various types, which include mismatching gap risk, basis risk, net interest position risk, embedded option risk, yield curve risk, or even price risk and reinvestment risk. These categories, which we covered, we will see tomorrow, And gap and mismatch risk is what? When the bank holds the assets and the liabilities they hold with different amounts, maturity rates, or the times when interest rates are reset. This creates exposure to changes in the interest rate. The gap is the difference between the amount of assets and liabilities that are subjected to interest rate changes during a certain time period, and when the due date for these assets and liabilities do not align, it can lead to the potential gains or losses which are based on how market interest rate move. Okay. Basis risk is what? When there is a mismatch in how interest rate change for different financial instruments, even in a perfectly matched gap positions. Okay. Ideally, if interest rate on deposits and loan changed equally, there would be no basis risk. Okay. And in reality, interest rates on different assets and liabilities rarely move in sync. Clear? Yield curve risk means which represents the relationship between the interest rate and the time to maturity for various financial instruments. As the economy changes, the yield curve shifts, affecting the bank profit. And the RBI can influence this curve by changing the government bond analysis. And also in this, price risk is what? What is price risk in this? They see. It occurs when assets are sold before they reach the maturity. There is an inverse relationship between bond prices and yields. Where market yields rise, existing bonds prices typically fall. This type of risk is important for banks because trading books that aims to profit from short-term interest rate changes. Earning perspective. The earning perspective focuses on how changes in interest rate affect a bank reported earning. Variations in earnings are very crucial, and in this we can say reduced earning and losses can threaten the bank financial health. Main focus to has been on the difference between what is the difference between interest income and the interest expenses. Economic value perspective. See, economic value perspective, if we see, the economic value of instrument represent the assessment of the present value of its expected net cash flows, which is discounted basically on the reflected market rates. This is type of an important consideration for the shareholders, management and the regulators because it reflects how sensitive a bank economic value is to interest rate fluctuations. Okay. What are the disadvantages of economic value added? EVA has lots of disadvantages. Basically, it cannot determine how effectively capital asset holder utilize the retained profits. And EVA also cannot calculate the return on expenses like research and development. Measurements here system should assess all the material interest rate risk associated with the bank's asset, liabilities, and the OBS positions. It also utilizes generally accepted financial concepts and risk measurement techniques. And these are very well documented assumptions and the parameters. Some of the interest rate risk measurement techniques. First one is repricing schedule, the simplest technique for measuring a bank interest rate risk exposure. Begin with a maturity repricing schedule that distributes the interest sensitive assets, liabilities, and OBS positions into a certain number of defined time bands buckets according to their maturity or time remaining till their next repricing. Then gap analysis. This approach is used to assess the interest rate risk of current earnings. It is typically referred as gap analysis. A negative or liability sensitive gap occurs when liability exceeds the assets. Conversely, a positive gap occurs when the asset exceeds the liabilities. A decrease in the interest rate also reduces the NII. Duration, that is also called modified duration. Now, is a measure of the percentage change in the economic value of the position that will occur given a small change in the level of interest rates. Okay, and sometimes there is a simulation techniques are there, that could be static simulation and dynamic simulation. Simulation techniques, basically these are the approaches that typically involve the detailed assessments of the potential effects of changes in the interest rate on earnings and economic value. By simulating the future path of interest rate and their impact on cash flows. Okay. Now, reducing the liability sensitivity by shortening the investment portfolio maturities, increase the floating rate lending, increase the long term deposit, increase the short term lending. Okay. These are the controls and the supervision of interest rate risk management. A strong control environment. Then risk identification and evaluation, controlling activities, robusting the information system, and the regular reviews. Okay. Now, board and senior management. Obviously, they are a board of director. Why board of directors are important? Because they approve all the strategies. They they make the all strategies. They monitors. They ensure that risks are controlled. Senior management, they are only responsible for managing the bank's business structure. They will set the limits, they will establish the system, they are ensuring the comprehensive reports, they are regularly reviewing the risk management policies to keep relevant things and effective. This IRBB is basically refers to that risk which in a bank capital and earnings due to unfavorable changes in the interest rate. When interest rate changes, the present value and the timing of the future cash flows also change, which impacts the overall value of the bank assets and the liabilities. Some of the enhanced guidelines of the on the IRBB, clearly defined risk appetite statement is there, regular monitoring of bank, establish the procedures for approving major hedging, system for promote management intervention, identification of IRRBB in all products. Let's see RAROC now and the profit planning. Okay. Bank have to hold minimum amount of capital based on the risk they are taking. Profit planning is what? Where the bank involves how to manage balance sheet with it, which include their loans, investment and non-fund income. Banks earn money from three main sources. What are these main sources? Interest income, fees based income, treasury income, and interest income comes from the loans and investments in securities and the bonds. Many countries have the regulations that require banks to keep a certain percentage of their deposits in government securities. And in India, specific rules ensures that the portion of deposits is allocated to these safer investments. Clear? Now, bank profitability depends on these factors: interest income, fees based income, trading income, interest expenses, staff expenses, other operating expenses. Now, see, many banks have evolved their own process to determine how much capital they need based on their levels and business plans. They consider both qualitative and quantitative factors to access their economic capital. Basel committee emphasizes that bank must not meet the minimum regular capital requirement, and they can evaluate the internal capital needs which are based on the risk which are associated. RAROC is that method which measures the expected and unexpected losses, which is using the models like value at risk. And the core idea is to match revenues, cost and the risk over a specified time period for each transactions or the portfolio. Basically, expected losses are covered by the reserves and the provisions, while unexpected losses require additional capital, which is based on the factors like confidence level and the market conditions. Same approach, another approach, that is earning at risk, which focuses more on cash flows than capital allocation. Banks have to estimate the frequency distribution of the returns, which is based on the historical data, and that accesses the extreme outcomes from the tail end of the distribution. Now, economic capital and RAROC, expected loss refers to the reserve banks, which need to set aside to cover the potential future losses. Unexpected loss means which indicates how much economic capital or risk capital a bank needs to support its financial risks. Okay. RAROC basically relates to the concepts like shareholder value analysis and economic value added. Traditionally, bank have to use the measures like ROR, return on assets and the return on equity to assess the performance, and this RAOE adjusts the profits, which is based on the total value of assets, while this ROE adjusts the profits, that is based on the value of equity. So neither ROA neither ROE effectively evaluates the business line because they do not take the risk into the accounts. Okay. RAROC is a part of group of measure which is called a risk adjusted performance measures. What is the method in this risk management is there? Measuring the risk, using the correct strategy for managing that types of risk. Capital allocations is also there. Performance measurement is also there. Okay, and this is basically the formula to calculate the economic value added. Clear? Now, banking industry in India. Recently, banks have merged, and State Bank of India, Bhartiya Mahila Bank are, see, recently these several banks have merged, such as the associate banks of the State Bank of India and Bhartiya Mahila Bank. Mergers are also occurring in the public sector. The RBI has allowed the establishment of small finance banks and the payment banks, which are categorized as differentiated banks. So the banking industry in India includes public sector banks, new generation private sector banks, old generation private sector bank, cooperative banks, regional rural bank, small finance bank, payment banks. Okay. And this NABFID, National Bank for Financing Infrastructure and Development, established as DFI, Development Financial Institution, to help the long-term infrastructure financing in India. This marks the creation of a new organization in the financial market. Okay. Okay, our two chapters only left: capital adequacy Basel norms and the liquidity management. So let's do it. Okay. Important chapter, we can say. This is one of the important chapter. This revised Basel framework is made up of three parts which work together to help ensuring in the stability of the banks. Sorry. These sorry. These pillars are: Pillar 1, minimum capital requirements. Then supervisory review of capital adequacy. Pillar 1 is what saying that this sets the basic rules for how much capital a bank must hold to cover its risk. And pillar 2 is about how regulators make sure banks have enough capital to handle all the risk they are facing. And pillar 3, this focuses on the transparency and the disclosures so the investors and others can assess the bank's financial health. Okay. Market risk, we know that risk of losing money due to changes in the marketplaces. Using a set of method to calculate the market risk based on the duration and the maturity of assets. Internal model approach, banks can use their own models to, like, value at risk to calculate the market risk. What is SRP? This focuses on ensuring that banks have enough capital to cover all the risk they are facing, including those that are not fully covered under Pillar 1. This is where the ICAP comes in. It requires banks to access their risk and the capital needs. Risk that not fully captured by the rules in Pillar 1, risk that not included in the Pillar 1 framework at all, and external factors that may affect the bank stability. This new capital requirement apply to the all commercial banks, and consolidated bank means where the group of companies, like licensed bank is the main controlling entity here, and also consolidated banking meet all the capital to risk weighted assets at all the time, just like individual banks. There are three pillars of Basel 3. And what is the main goal of Basel Committee? To update the 1988 Basel Accord. This revised Basel III framework aims to improve risk management practices in the banks and allow banks to use their own internal systems to calculate how much they need the capital. In this allocation, capital is required to cover all the operational risk, and Basel third is there to basically for how banks can determine their capital needs for the credit risk and the operational risk, and also emphasizes the importance of consistency in how these are calculated. What are the key features of Basel third? What are the key features of Basel third? Basel third establishes a minimum level of capital for level of capital minimum level of capital for internationally active banks, but national regulators can set the higher capital standards. And also this framework is more forward looking and flexible. It requires not just to allocate the capital and also to disclose the more information about these risks. Banks are encouraged to improve their internal risk management systems. Three pillars are there: pillar 1, pillar 2, pillar 3 of Basel third. Okay. What pillar 1 say? Under pillar 1, banks are required to hold a certain amount of capital to cover the risk. This capital is calculated using the regulatory capital and risk weighted assets. And the definition of regulatory capital is similar what we used in the 1988 Basel Accord. The different types of capital are Tier 1 core capital. This includes the bank's paid up capital, reserves and any unallocated profits minus deductions. Okay. Now Tier 2, that is supplementary capital. This includes things like long-term debt, loan loss reserves, revaluation reserves. Tier 3 capital, this was introduced in Basel II to cover market risk but has been phased out under Basel III. Risk weighted assets now also include capital for market risk and the operational risk. The calculation for total risk weighted assets include the risk weighted assets for the credit risk, the capital required for market risk, which is multiplied by the 12.5, and the capital required for the operational risk also multiplied by 12.5. This is the formula. Total risk weighted asset is equals to risk weighted asset for the credit risk plus 12.5 multiply capital requirement for market risk plus 12.5 multiply capital requirement for the operational risk. Basel third, pillar 1, pillar 2, pillar 3. It enhanced the minimum capital requirement and liquidity requirement. It enhanced supervisory review process for the firm-wide risk management and capital planning. It enhanced risk disclosure and the market discipline. Okay, so now pillar 2, supervisory review process. This capital adequacy ratio set by RBI under pillar 1 is the minimum regulatory requirement. It covers only 3 risks: credit risk, market risk, operational risk. Okay. Some risk may not be fully accounted for under the pillar 1 framework. A bank actual exposure to risk might be higher depending on the quality of the risk system. And internal assessment of the banks is also necessary here because bank have to assess their own risk. Bank have to identify, evaluate all types of risks. They have to determine how much capital they need to cover these risks. They have to maintain the extra capital also. And what are the guidelines of the SRP of the RBI and the ICAIIB of the banks? Basically, under Basel 1, the focus was solely on setting the minimum capital requirement for the banks. However, Basel II expanded this approach by introducing 2 additional components: the supervisory review process and the market discipline. Pillar 1 is saying minimum capital requirements. Pillar 2 is supervisory review process. Pillar 3 promotes the transparency. Pillar 2 is saying risk management should be strong. What are the key principles of the supervisory review process? Principle 1, banks should assess their capital adequacy based on their risk profile and have a strategy to maintain appropriate capital levels. Principle 2, supervisors should review and evaluate the bank's internal capital adequacy assessment and the strategies. If the regulators are not satisfied, they should take appropriate actions. Pillar 3, supervisors should have expect that the banks to hold more capital than just the minimum required by the regulation. And principle 4 is saying that the supervisor should step in early if the bank's capital is at risk of falling below the minimum requirement to support its activities. Okay. What is the supervisory responsibilities? Reviewing the cap, taking action if needed, ensuring the compliance, early intervention. These are according to the different principles. Okay. What are the structural aspects of the ICAP? Every bank must have an ICAP. Firm wide risk profile. ICAP should reflect the overall risk exposure of the entire bank. It should consider all the types of risk the bank faces, such as credit risk, market risk, operational risk, and bank's senior management needs to understand the importance of assessing risk across the whole organization so they can identify and addresses the emerging risk very quickly. What are the responsibilities of the board of directors? They have to set the risk tolerance. They have to ensure that the senior management sets up the risk framework. They have to establish strong internal controls. Okay, now what is risk measurement, monitoring and reporting? Management information system should provide the board and senior management with clear and timely updates. On the bank's risk profile. This helps them to make the informed decision, means the measuring and monitoring is very important. Okay, means measuring and management is very important. Internal control is necessary for the regularly testing and monitoring. Submission of ICAP outcome is also important. And at least once a year, board of director must assess whether the ICAP is working as intended and is also ensures ICAP effectively meets the objectives set by the bank. Then this ICAP should be integrated into the bank's overall management and the decision making process. And principle of proportionality is here. For a simple bank which are having the less complex operations are less, ICAP should be straightforward and focus on identifying the major losses, listing the biggest risk the bank faces, estimating how much capital the bank might need if those risks happens, and projecting the future capital needs, and also estimating the range of capital which are needed under various scenarios, and also determining the quality and the amount of capital basically the bank should hold. Okay. And there is also regular review is important for the ICAP, so the every internal audit and the external assessments will be done properly. Process should be accurate and proportionate to the bank's activities, and there is an integrity and accuracy requirement. Capital assessment is requirement, identifying the risk, data accuracy, reasonable assumptions, and the stress testing. ICAP is a forward looking process. Okay, this should be a forward looking, meaning it must consider all the future development such as banks' strategic plans, changes in the economy, Potential challenges. The management of the bank must create a strategy to ensure that the bank holds enough capital to match the size, complexity, and the risk of both on balance sheets. A bank capital adequacy depends on its risk profile, the types and the amounts of risk the bank is exposed to, and identifying and measuring the key risk in ICAP, credit risk, all the types of risk basically. ICAP is basically a detailed report that is explains how a bank assesses all the risk it faces, how it plans to manage these risks. This document is submitted to the RBI and must be approved by Bank Board of Director. It should be written clearly so both banks and the RBI can understand the bank risk level and the capital needs. Risk, every type of risk should be analyzed in this case. For every risk, means every risk should be taken in the not positive manner, like with the should be assessed and should be try to manage and mitigate them. Then pillar 3, okay, this focuses on the transparency and encourages banks to disclose the information to the public. This helps investors, regulators here, and the market to assess the risk the bank is taking and how well it is managing those risks. This idea is that when the market has full and accurate information, market discipline also supports corporate governance. And as the 19th century banker Walter Baggot said, a well-run bank needs no capital. No amount of capital will rescue a badly run bank. Yes. uh, General disclosure policy. Each bank should have a formal disclosure policy that this should be disclosed to the public. What information the bank will disclose, how the bank will control the disclosure process, how the bank will assess if the information disclosed is appropriate, accurate, and timely. Qualitative disclosures are like basically this sections explains how the bank assesses whether it has enough capital to support its current and future activities. It includes a discussion on the bank's approach to measuring and ensuring that it has adequate capital to handle its risk. Quantitative disclosures are there. Capital requirements for the credit risk standardized approach should be securitized exposures. It should be capital requirements for market risk. It include interest rate risk, foreign exchange risk, equity risk. Credit risk disclosures, qualitative disclosures, basically the definitions. The bank will explain how it defines terms like past due and impaired for accounting purposes. And credit risk management, like a summary of how the bank will manage the credit risk. Trading book. The bank must disclose the amount of securitization exposures in its trading book. Bank needs to show the capital requirement for its securitization exposures, broken down by the risk weighted categories. Now, market risk in trading book. The bank should explain the market risk involved in the trading activities. The bank needs to disclose how much capital it needs to cover the risk like interest rate risk, equity position risk, foreign exchange risk. This is a qualitative disclosure which includes how to manage the counterparty credit risk. And also RBI issues guidelines. Banks in India have to follow the disclosures in their financial reports. These disclosures are very important because they provide the clear picture to the bank about the bank risk and the financial situation, and beyond the specific disclosure requirement, banks are responsible to give an accurate representation of their actual risk profile. And in addition to the required documents, bank must share the information with the sorry for that disturbance. Just give me a minute. Okay, now everything is fine. Okay, so this Reserve Bank of India issued some types of guidelines that banks in India have to follow the disclosures in their financial reports. These disclosures are very important for providing the market with a clear picture of the bank risk and the financial institutions. Beyond the specific disclosure requirement are set out by the basically the guidelines, and banks are responsible for giving an accurate representation of their actual risk profile to the market participants. Okay. So after this, securitization exposures in their trading book, bank have to disclose the information about their securitization activities, sponsorship of the off balance sheet vehicles, validation of the securitization exposures, pipeline and the warehousing risk also there, and also they are related to the this pipeline. Okay, and apart from this, there are some types of RBI circulars on the HTM securities. HTM securities means held to maturity category, where basically what is this is uh, to category to profit from favorable market conditions. HTM securities are meant to be held until maturity and are not required to be marked to market. Okay. RBI stated that if sale or transfer of HTM securities exceeds the 5% of the value of investment in the HTM category at the beginning of the year, bank has to disclose the market value, the excess book value. They have to disclose in the HTM securities and excess book value over the market value. Okay. Sometimes RBI have to identify the discrepancies in the bank's assets classification and the provisioning. RBI have to RBI requires banks to disclose some types of additional provisioning and additional gross non-performing assets. That is basically according to the guidelines. Okay. Okay. Just give me a minute. We have one chapter left, that is liquidity risk management, right? Okay, just give me a minute for this. Just give me a minute. I am sharing the screen for the liquidity risk management. We have that chapter left in our module D, right? Liquidity. Just only give me 1 minute. Sharing here the liquidity risk management PPT. Need only 1 minute. Liquidity management. Okay. I think now visible to everyone. Liquidity management. Okay, this chapter is left only. Okay, so ALM in banks focuses on the two goals, that is profitability and ensuring the liquidity. Liquidity refers how easily assets can be turned into cash or how easily a bank can meet its short-term obligations. Liquidity risk, which arises from the possibility of not having enough enough cash or capital to meet these obligations. Okay, and also, if we talk about this 1980s and the 1990s, several banks faced this liquidity crisis. Okay, several banks faced the liquidity crisis, and they know how the liquidity risk is important. Banks need liquidity to meet the customer demands like deposits, withdrawals, and the loan request. A bank liquidity need depend on how much demand there is for loans and how much its deposit base fluctuates. Liabilities are very important for the banks because they are helping in managing the expected and unexpected changes. And the cost of liquidity depends on the market conditions and how the market views the bank risk, such as interest rate risk, credit risk. Okay. And liquidity management in a bank is the process of ensuring that banks have enough funds so they can meet their obligations like loan commitments, deposit withdrawals at the reasonable prices at all times. Okay. Banks can manage their liquidity so they can cover their obligations. And they have to meeting the new demands, new loan demands, and also fulfilling the existing loan commitments, handling the deposit withdrawals. These are the things basically that is banks have to manage for covering their basic obligations. Okay. If bank has enough liquidity, so some factors that should be analyzed. What factors are like past funding requirements, like looking at how much the bank need in the past, current liquidity position, estimating how much liquidity the bank will need in the future, what are the sources of funds, considering the ways for reducing the amount of funding needs, and also assessing the asset quality, earning capacity, capital position. And if to raise funds and meet its liquidity needs, selling the liquid assets, increase the short-term borrowings, selling or reducing the holdings, increase long-term borrowings, and also raising the capital. Liquidity management and understanding liquidity risk are very critical. How many types of liquidity risk? There are internal factors and the external factors. External liquidity risk are basically geographical risk, system risk, instrument specific risk. Geographic risk means that when the regions are there, risk related to the regions. Systematic risk that fails the entire system, and that does not means that systemic risk is only affecting one bank. If systemic risk occurred, then means all the banks faces the consequences. Systematic risk failure means failure of bank, and it includes market crash. And the problems with the particular financial product, bonds and the derivatives are included in the instrument specific risk. Funding risk, this occurs when a bank need to replace the unexpected outflows of funds. Okay, customer wants to withdraw their deposit early, so they are not choosing to renew their deposit. This causes the funding risk to the banks. Banks are now funding risk can be caused by the fraud. Okay, basically, which leads to the financial losses, systemic risk like a financial crisis which affect the whole market, and also loss of confidence from the customers or the investors, and foreign currency liabilities which might be harder to manage if bank does not have enough foreign currency to meet the obligations. That is called funding risk. Call risk, when contingent liabilities become actual liability, or when a bank can't take advantage of profitable business opportunities. Okay, because it does not have the liquidity to act. Call risk can happen due to non-fund based limits turning into fund based limits, and foreign currency and the liquidity can add the problems to the liquidity management, and in some cases banks basically might not have enough domestic funds to meet the foreign currency obligations. If the foreign creditors are uncertain about the bank's financial health, they may panic due to rumors of a crisis. So, in short, liquidity risk comes from the many types of sources, some such as internal and external. And bank have to manage these risks carefully to avoid a liquidity crisis that could affect their ability to meet the obligation and continues the operations. Then how to measure and how to manage the liquidity risk is a crucial task for the commercial banks. Why? Bank has enough liquidity to meet its obligation, okay, which prevents some serious financial issues. Proper liquidity management reduces the chances of a bank getting into irreversible crisis. Even when a crisis occurs due to issues like sharp decline in the asset quality, uncovering fraud, or a widespread loss of confidence, it how bank manager liquidity can give it time to need to address the problem before it worsens. Worsens means worse situation. How to manage the liquidity effectively? By strong management information system, by having the central liquidity control, analyzation of net funding requirement, diversification of funding sources, and the contingency planning. How to develop a structure for managing the liquidity risk? Effective liquidity risk management requires a well defined strategy, strong oversight from the bank board and senior management, because see, liquidity risk is an essential part of the bank overall business strategies. Communication is required, board oversight is also required, and organization for liquidity management. So proper committee should be there who basically focuses on the treasury department, okay, and also who basically include the senior management, treasury department, or the risk management team. Treatment of the foreign currencies in the liquidity management, like market confidence and the reputation is treatment of the foreign currencies in the liquidity management. Basically banks have to banks are well known to their investors. Difficulty is there in the mobilizing the equity. We have to take the important thing, cash flow mismatches. Okay, see, stock approach focuses on the snapshot of the bank assets, liabilities, and the off balance sheet exposures at a specific point in time. These are the some important ratio. First one is core deposit to total assets, volatile liabilities to total assets ratio, short term liabilities to liquid asset ratio, prime assets to the total asset ratio. These are the basic important ratios. Market liabilities to the total asset ratio. Flow approach is basically looks at the how liquidity flows over time and focuses on managing the bank's liquidity need as they arise. So it measures and manages the net funding requirement, it managing the market access, and the contingency planning should be there. What are the scenarios for managing the liquidity risk? Just general market conditions. How to determine the marketability of assets? These types of assets are still marketable but may take longer to sell or may lose value when they sell quickly. Assumptions about the liabilities, like just now contingency planning, important concept. Bank needs to be ready for the emergencies with a clear contingency plans. First one is crisis strategy. This is a plan for what a bank will do during a liquidity crisis. Coordination of efforts, clear communication, division of responsibilities, adjusting the assets and the liability behavior, customer and partner relationship. During a crisis, the bank may need to prioritize some relationships over others to preserve the liquidity. The bank should handle its public image carefully to prevent the panic. And here are the guidelines for the maturity buckets, like tomorrow 2 to 7 days and up to the 5 years. So as as per our strategy, as per the strategy, we covered our module A and module D today. Okay, module A and module D today. In tomorrow's class, we will cover our module B and module C. So in any aspect, if you like today's class, just give the thumbs up and do the comment. And thank you so much for attending that long time class. So we will meet tomorrow for module B and module C at sharp 6 p.m. And also do subscribe to this channel and like to this video obviously, and do the comment that good or not good. Good. So thank you so much. Thank you everyone. We will discuss module D, module B and module C. Now you will see there is a separate class for the MCQs. If I will not take the MCQs on that day, so this class will become more long, okay, or more with more duration. So thank you everyone. Thank you so much. Have a good night all, and yes, thank you everyone.